As an asset allocator, I don't think I've ever been so interested in stocks.
Corporate health looks very good right now, and we do feel very good about that.
The momentum continues to get even stronger than it had been earlier this year.
Everybody is trying to get into the AI world. The question will really be who ends up using it better.
Get the popcorn out, because this AI revolution in 1995 moment is just starting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It was supposed to be a quiet end to the week. It really hasn't been. Good morning. It is Friday, though. Welcome to Bloomberg Surveillance. If John were here, he'd say, let's get you to the weekend, and we'd all cheer. He's already on a well-deserved break. Annmarie is here, maybe with suitcase in hand. Danny Berger pulled the short straw. She's kind enough, as always, to put up with us for 3 straight hours. I think Ian Lingen really put it the best. Yesterday, he said, we came in today's session, yesterday, assuming that the only thing more boring than Thursday before a long holiday weekend would be Friday morning. Alas, the price action proved to be far more exciting than anticipated, Danny, with a stronger services PMI print as the most readily identifiable trigger. Danny, what a mood shift starting yesterday around 10 a.m.
I think if you had told anyone that some second-tier data of PMIs would trump Nvidia, and they had said, yeah, I believe that, they would have been lying. There's no way. We all thought Nvidia would be the big macro event. So what happened? Were we too one-sided? Is it because FedSpeak got us nervous before this data? Is it the AI pie can't possibly lift all boats? I don't know what it is, but it feels like a big sentiment shift.
Anxiety around inflation. I put this to Chris Williamson, the chief business economist at S&P Global Market Intelligence. Says companies remain cautious with respect to the economic outlook, uncertainty over the future path of inflation, interest rates also, citing worries of geopolitical instabilities and the presidential election.
Given this, pulling back, there's this feeling that today's actually 10 a.m. University of Michigan sentiment survey once again matters. Yes, they may pull about 500 people online through instant messages or whatever else they do. At the same time, should people start to really have deteriorating sentiment, Annmarie, there is a feeling that this is going to have a bigger impact on people's views going forward, not only of how hard it is to kill the inflation boogeyman, but also politically.
So we see in the earnings report, Starbucks, Walmart, Target, trading down, trading in, looking for those cheaper products. And then we have Janet Yellen, who's in Sintra, meeting with other financial chiefs around the world at the G7. This is what she had to say to the FT. She talked about the concern, trying to be empathetic where the American consumer is right now. And she says they see it when they shop for food in terms of rentals, higher mortgage rates. It's tough for young people who would like to get on the housing market to enter this market.
At the same time, I feel like that's a little bit more sympathetic, a little more empathetic than what we've heard from Biden. Biden has had this tone that's almost like, look, I know you don't think the economy is good, but we know it's good. We know it's better than you say it is. I have to say, looking at the U.S. PMIs yesterday really did show us that for businesses, they are doing well, despite what business sentiment says. So even that shows us, okay, take these sentiment surveys with a grain of salt.
Business activity coming in at the fastest pace in 2 years, looking at prices paid, and this was sort of the rub, coming in at the highest pace since 2022, raising this question. Everyone was expecting that services inflation would come down to goods inflation. We are seeing it potentially move in the opposite direction. That, to me, is part of the rub. I do want to just bring this. Yesterday, we really were thinking it was all going to be about Nvidia really lifting all boats. And then we did get this inflation read at a time where you do have a lot of people looking for a cool-off. Michael Hartnett coming out this morning, Danny, saying the rally in global equity markets is at risk of overheating. Barclays talking about how it's starting to look tired. How realistic is that?
I think that you saw some of that yesterday when, by the way, not just non-AI things sold off, AI things sold off yesterday. AMD, Intel, they fell more than 3% yesterday. If Nvidia is the AI tide lifting only AI boats, it didn't even do that. And utilities, Lisa, I know you've been talking about this so much. They were hurt a lot yesterday, too. I mean, that to me seems like exhaustion.
Which led to the biggest sell-off in both the S&P and the NASDAQ of May. You see that biggest decline, of course, particularly in the Russell 2000 yesterday, going back to the end of April. Here's a state of play, a little bit more optimistic, up about 0.25% to start the trading day, a little bit less than that on the S&P. You could see a little bit of dollar dollar weakness, been toggling around here for a while, basically steady at the 108.31. You could see 10-year yields just a little bit lower, but yesterday really climbing on the prospect of potentially some sort of ratcheting back of expected rate cuts. Coming up, we've got Lee Farage of State Street as U.S. stocks pull back from record highs, Bloomberg's Craig Trudell as Elon Musk rejects tariffs against China, and Ian Shepardson of Pantheon on the global economic outlook as leaders converge, as Annmarie was talking about, at the G7 in Italy. We begin with our top story, U.S. stocks easing from fresh records despite 9% surge from Nvidia. Investors looking ahead to another busy schedule of U.S. data next week. Lee Farage of State Street writing this. If we do see higher inflation prints for May and perhaps June, then one cannot ignore the prospect of the next move being a rate hike. It is a bigger tail risk now than it was just a few weeks ago. Lee joins us now. Lee, good morning. Thank you for being with us. I want to just start with what you made of yesterday's price action where Nvidia's blowout moonshot couldn't overwhelm even the slightest tick up in the prospect of goods inflation.
Yeah, thank you for having me. I think what yesterday showed to me is the balance of risks in the market have now shifted. So before, you'd see a bigger reaction to positive news to the market, be that, lower inflation, or be that, some sort of sign of a slowdown in the economy, which would seen as setting the path for the Fed to cut rates. That would cause a bigger market reaction than stronger data, because stronger data, well, it's coming, the slowdown's coming, the Fed are going to look through this. Yesterday showed me that balance of risks in the market, in the mind of market participants, is shifting. The Fed have told us now they're going to need time to trust the downtrend in inflation again. Is that 2 more prints, 3 more prints? We don't know, but they've told us they're going to need time. On the other side of the equation, if you get strong data from here, you get a strong inflation print, how quickly does that feed into the Fed actually starting to think about hikes, which, various members in the minutes, we saw what they said on Wednesday, various members said they would hike rates further if the data warranted it. And I just think that balance of risks and the way we react to data has shifted over the last few days.
Lee, you've had a positive bias to risk assets, in particular to equities. How much was the price action yesterday instructive of just how at risk equity valuations are to the idea of faster inflation and the prospect of a rate hike being back on the table?
Yeah, I think it's become a real prospect, as I wrote in my notes. Look, a hike is still a tail risk. It's not a central view. I would put it 25%, okay, which is probably much higher than probably a lot of people would put it, but still a tail risk. But it's there. And, the Fed have openly talked about hikes. They haven't mentioned the hike word for a year, but now they're starting to talk about it. And I think that vulnerability is now there in the market. Look, central view, I still think, data, if it's okay over the next month or two, as long as the market believes the next move is a cut and believes we're entering a cutting cycle, then I think risk assets can continue to perform well for the next month or two. But it's going to get more volatile, I think. We're going to see more days like yesterday. Overall, probably uptrending tax, but we're going to get more days like yesterday. And if the market really does start to believe the next move could be a hike, then that's going to signal the top in the market for me.
Lee, but what about this idea that even if policy was to remain tighter or even get more tight, the reason it's doing that is because of economic strength? And if it's because of economic strength, then equities are okay because earnings are okay. Is that not the case anymore?
Yeah, and that's been the narrative all year. We've pushed back. Don't forget, at the start of the year, we had 7 cuts in for this year somehow. And the first move was meant to be in March. And that all got pushed back, and equities were up 10%. Because it was extend and pretend. We were pushing out the rate cutting cycle. We didn't take the rate cutting cycle away. We just delayed the start because the data was so good. And as long as we can keep doing that over the next month or two, then stocks will be fine. But if the market really does sit back over the next couple of months and say, are we right about this cut? Are we right about this cutting cycle? If the Fed signals they need to hike, why are they signaling they need to hike? Because they need to slow the economy more to get inflation back to target, to get it trending back to target. So soft landing sort of goes out the window because the Fed is saying, look, this isn't working. We need to slow this economy a lot more. We need to hike rates. And then suddenly that argument that, stronger data is good for markets suddenly doesn't look as clear-cut as it was before, because stronger data means the Fed have to do more.
Well, Lee, let me give you the other argument then of why stocks aren't vulnerable and why they can be more resilient, is that it's AI. It's AI come to save the day. Perhaps yesterday proved to us that that's not necessarily the case. If something like AMD is also falling with Nvidia, is that trade also tired out, that in AI is a rising tide that lifts all boats?
But we've come a long way. The AI story has come a long, long way. Look at where Nvidia is. And no, I don't think the story's played out. I think there's further to go. And I think AI-specific stocks will continue to outperform. But the rest of the market is going to struggle to continue to play, as you say, play that sort of AI rising tide. And I think that's what we saw yesterday, even with Nvidia having a great day. The rest of the market could not go with it. So I think the whole thing that the AI is going to lift everything, I think that story's run its course. Not AI specifically, but the boat that's lifting everything. I think that story is looking very tired now.
Lee, if we can go back to your tail risk about the hike, you're the second person this week to come on this program and talk about that. We had Adam Posen on, and what he was concerned about was the fiscal impetus going into next year, how much spending we're going to get from Washington. Say we do see a lot more spending in 2025, tax cuts, another, fiscal package. Potentially there's going to also be tariffs that can be inflationary. What kind of vulnerability could we see from that idea of a hike?
Tremendous. I mean, we've come a long, long way. If the market really believes that the Fed has to hike to slow the economy, then yes, I think you are going to see a fairly significant pullback. Look, we've come a long way. Even if we pulled back 10%, we're still flat for the year. And I don't think it'd be that much more than that. But a pullback of that magnitude, if the market starts to price hikes, is fully possible. And look, the fiscal thing is important because everyone's sort of assumption is on rate hikes. Policy is restrictive, therefore the next move has to be a cut. Well, look, rates are above neutral for sure, although not as far above as we thought. I think neutral is probably 4 to 4.5% nominal, and the Fed sort of hinted that they believe that rates aren't as restrictive as they thought the other day. But policy isn't just rates. Policy is made up of the level of interest rates, the size of the Fed balance sheet, which is still significant and bloated, and fiscal policy. And you take those together as a combination, policy itself is not restrictive. And that is what the data is telling us. That is why the US economy is growing at 3% year on year, close to double the Fed's estimate of trend growth. If policy was restrictive, we wouldn't be growing the way we are. Policy is not. Rates might be above neutral. That does not mean that policy overall is restrictive. So if you loosen fiscal policy further next year, by definition, you have to tighten it somewhere else. And the only tool that really you can do it through is higher interest rates.
Lee Farage of State Street, thank you so much for that. We've come a long way, which really kind of echoes the sentiment that we heard from Michael Hartnett. Risk of overheating and Barclays looking tired. Right now, let's get you an update in stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Haqqis. Yahaira.
Lisa, Nvidia CEO Jensen Huang had a good day yesterday. His net worth grew by almost $8 billion to $91 billion as shares of Nvidia rose 9% following better than expected quarterly results. A majority of Huang's net worth comes from his stake in Nvidia, which he co-founded back in 1993. According to the Bloomberg Billionaires Index, Huang is now the 17th richest person in the world. Elon Musk's SpaceX has initiated discussions about selling existing shares in a deal that could value the company at $200 billion. That's according to people familiar with the matter. The valuation would be a premium to the $180 billion it fetched in its previous tender offer. SpaceX is already on par with some of the world's largest publicly traded companies by market cap. And hundreds of students walked out of Harvard University's commencement ceremony yesterday. This in protest of the governing board's decision to withhold degrees for 13 students who took part in a pro-Palestinian encampment on campus. A mix of graduate and undergraduate students stood up and chanted as they left in the middle of the ceremony. They continued to protest within earshot while the ceremony continued. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And aside from that, congratulations to the graduates. Just on a more general note, up next, Tesla pushing back on tariffs.
Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
That's next. You're watching Bloomberg. After the biggest sell-off so far this May in about 3 weeks, we are trying to claw back a couple of, at least a bit of those gains. You could see about 0.25% gain on the S&P in early trading. You could see a little bit of dollar softness. Again, a risk-on tone as people look to potentially both stronger economic data as well as maybe a Fed rate cut coming in September. Under surveillance this morning, policy and front focus, Tesla pushing back on tariffs.
Neither Tesla nor I asked for these tariffs. In fact, I was surprised when they were announced. Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
Here's the latest. Elon Musk criticizing the recent tariffs announced by the Biden administration on China's Chinese-made EVs. Musk saying he favors no tax incentives for EVs while avoiding a question on whether Tesla would bring a cheaper model to the public. Bloomberg's Craig Trudell joining us now. So, Craig, riddle me this. On one hand, what people say in public feels a little bit different than what they might say in private. How difficult is it for not just the Elon Musks of the world, but the BMWs and the Mercedes of the world as they face off with the Chinese threat?
I think it is. It's a great question because BYD has proven extremely competitive, and it's not just me saying that. I mean, Elon Musk was saying that and has repeatedly said that. Quite recently, I think, in January, he was asked about just how tough the Chinese are. And he, said that he thinks that they will have significant success outside of China, depending on what kind of tariffs or trade barriers are put up. And so, while he said yesterday that he was surprised by this, I don't know that I necessarily believe him in that, this has been well telegraphed. And he himself has referred to this idea that, if trade barriers are not established, that they will really give, the likes of BMW and Tesla a real challenge.
So, Craig, how much is it political? We know that Elon Musk has kind of weighed in on the political sphere. And how much is this purely out of business interest, given the fact that Tesla's got a significant presence selling in China, as well as BMW, as well as a lot of the German auto manufacturers?
I think that absolutely has to be coming into play here because, he referred to this idea of, no tariffs in China, which is silly. There are, tariffs. China does really kind of insist for the most part on you producing locally. He also referred to this idea that, Tesla hasn't had preferential treatment, which also is a questionable claim. They were the first foreign car company to be let into China that didn't need to set up a local joint venture with a local manufacturer. So, Tesla has, gotten some help in China. I think it also is just, the case that Tesla has significant business there exporting to other markets. And Musk would rather not see, a sort of escalation of tensions between China and the U.S. or China and Europe. And, here in Europe, he's quite reliant on the Shanghai factory, sending over Model 3s. And, he is making some Model Ys in Germany. But this is absolutely the case that his plant in China is, their export hub.
Craig, when it comes to Europe, we heard from France's finance minister earlier this morning, Bruno Le Maire, talking about the overcapacity and concerns with China and saying that there needs to be, quote, a united front when it comes to dealing with China. He's speaking alongside G7 partners. What is Europe's plan right now? Where are they in this process of dealing with China's dumping on their market?
Yeah, we're only weeks away from, getting a better sense of, what exactly the next step is that Brussels is going to take here. I think, there's a general sort of, consensus or assumption that tariffs will go up. I think, the Chinese manufacturers, saw this coming and actually have been, kind of conservative in terms of how they've priced their vehicles. There have been quite a lot of EVs coming into Europe from China. But, when you actually take a look at what, say a BYD charges for its vehicles in Europe, they're quite a bit more expensive than they are in China. And, some of that, of course, is, localization differences and perhaps slightly more robust, crash worthiness, because there is, there are higher standards for those sorts of things in Europe than there are in China. But I do think it's been the case that they were trying to avoid this sort of clash and just weren't able to, because even a sort of, initial, bit of exporting from China, without a huge amount of success was enough to really set off alarm bells. And to the extent that we have seen some success, it's been Tesla exporting from Shanghai, and it's been MG, which is owned by a state-owned company and used to be a British brand. And so a lot of Europeans kind of assume that they're buying a British car when in fact they're buying one from a state-owned Chinese company.
Tesla was also out with their 2030 report. Do you get the sense that Tesla is prioritizing autonomy over the market share and the core car business?
I think, it's clear as day at this point. Yesterday, Tesla putting its impact report out, the last couple of years, they alluded to this idea that they wanted to sell 20 million cars by 2030. In order to do that, they're going to need to offer much cheaper electric vehicles. And we've seen, one indication after another the last, couple months that Musk is less interested in that pursuit and wants to really sort of double down and focus more heavily on autonomous driving. And that's been something that even, very bullish Tesla investors have been nervous about, because we've seen real issues with companies, running into problems with trying to commercialize that technology. It has a lot of promise. It's been something that, a lot of people have been very interested in, but the, nuts and bolts of getting these onto the road and dealing with potential crashes and the costs of bringing this to market, it's proven much more difficult and may be a several year, even decades phenomenon, as opposed to something that is going to be ready for prime time soon.
I have to say, Craig, it's pretty incredible that at Viva Tech, he basically avoided or answered indirectly all questions about this, all questions about whether he's still committed to low-cost vehicles. But it was only a month ago in his earnings, he literally talked about their growth mostly being underpinned by low-cost vehicles. What Musk are we supposed to believe in?
I do think, there was more than a few contradictions in what he was saying yesterday. My assumption is that he was sort of hearing yesterday's question is really more so alluding specifically to this idea of a standalone, brand new $25,000 Tesla. A lot of people refer to it as the Model 2. And I think that car is just not, a priority for him. Again, he wants to, go the self-driving route instead. And I think, reading between the lines of what he said on the latest earnings call, it really just sounds like they're working on, taking some of the development that work that went into that $25,000 car, applying it to their existing lineup, and spinning that as we're going to offer more affordable electric vehicles as soon as late this year, but leaving out the particulars, which I think it means that we're going to see a cheaper Model 3 or Model Y late this year or early next year.
Craig Trudell of Bloomberg, thank you so much, as always. And it's always a little confusing to know which Musk to listen to, as it can sometimes be contradictory. Coming up today, we do have a little bit of economic data in an otherwise light day. We have data at 8:30 a.m., durable goods. At 10 a.m., we get University of Michigan sentiment survey, as well as a look ahead for inflation expectations. Right now, what you could see in markets is a lift. Maybe the AI theme isn't as tired as people think, with the year-to-date gains on Alphabet and Meta up more than 24%. We'll talk about some of their issues with AI. This is Bloomberg. Closing out a week before a long weekend, it is supposed to be boring. It isn't because of what happened yesterday with the blowout from Nvidia and then the add-on to a higher than expected inflation reading as well as business activity. Today, good news yesterday is good news today, at least on the margins, about 0.25% lift for the S&P, trying to claw back some of the losses from yesterday. On the NASDAQ, up about the same again, sort of surprising that even with the Nvidia gain of about 9%, we still are seeing the NASDAQ down yesterday, the most in 3 weeks. And the Russell, to me, I mean, honestly, Danny, this to me has been one of the biggest mysteries. When is the Russell going to finally get a bid? It seems to be entirely dependent on what's going on in the bond market.
Yeah, I had this aha moment talking to Max Kettner at HSBC, who basically said 40% of small caps are floating rates. They have floating rate debt, so they are extremely exposed to higher rates. So as good as the economy may be, they can't rally until there are cuts.
Which is the reason why everyone's focused on the bond market, including Mike Wilson of Morgan Stanley. When you take a look at 2s, 10s, and 30s, you could see today a bit of a bid after yesterday's sell-off, pushing the two-year yield to 4.92%. Again, just creeping closer to that 5% threshold over the next 2 years, with some people, including Lee Farage earlier, talking about potential rate hikes. 10-year yields 4.47 rounded up, and 30 years 4.58%. In the commodity space, you can also see a bit of a decline, at least in oils. But with the currency levels, to me, what is fascinating is this question in the Eurozone of just how much they can cut rates. Annmarie, I think this is fascinating, given the fact that we had expected them to cut rates in June. That's pretty much a given. But increasingly, some better than expected data, in particular wages negotiated, pushing back some of the expectations of how much they can cut this year.
And does that mean that they actually do have inflation under control if you see wages going up? Does this spell potentially a June and hold environment? Because let's be honest, Christine Lagarde basically said this week, it looks like inflation is at a place where we can make that first cut. They have been talking about it since when? We were at Davos in January, that June cut on the table. Everyone's expecting it, but what happens after is the real question.
Isabel Schnabel of the European Central Bank this morning came out and said that a possible June rate cut would be a compromise, and talked about why after that it's going to be somewhat challenging. All right, under surveillance this morning, Treasury Secretary Janet Yellen is set to meet with ECB President Christine Lagarde at the G7 today. The conversation coming after new comments from Yellen on inflation and tension with China. Yellen saying she wants a, quote, wall of opposition to counter China's state-driven policies. Annmarie, what a shift, given how much she embraced some of the globalization narrative earlier.
Yeah, we've seen a shift with Janet Yellen over the past 3 years as Treasury Secretary. What's interesting is the Biden administration really has wanted this multilateral approach when it came to China. I'm struck by Bruno Le Maire's comments this morning, the finance minister over in France. He's talking about China's industrial overcapacity and how the G7 must present, quote, a united front to protect industrial interests. Well, it was only a year ago when Emmanuel Macron gave this pretty stark interview with Politico, and he talked about the fact that the great risk Europe has is actually there is a crisis and it prevents them from having their own strategic autonomy. So my question for Europe would be, well, which one do you want? Do you want the united front, or do you want the strategic autonomy?
Well, there's some bit of irony of Yellen asking for this, of wanting this united front. If you look at how the G20, the G7 rundown basically went yesterday, you had all these speakers from Europe. You had Le Maire talking about economic lethargy. You had Villeroy saying the U.S. is much stronger than us, we're struggling. And then Yellen basically coming out and saying, actually, the global growth is really good because of us. You're welcome, world. Of course, she didn't say that exactly. So for her to say that and say we have really strong growth and that Europe is complaining, and then on the other hand say we need a united front against China, I mean, surely she sees some of the contradiction in that.
There's also a contradiction in her wearing the economist hat and her wearing the political hat at a time where it's very difficult to parse both the idea that inflation is about 19% higher than when Biden took office in the United States, while also that on the margins, economic data points to a deceleration in inflation and some of these more, complicated metrics to really grapple with when you're facing off in the grocery store?
I think with Janet Yellen, if she puts her economist hat on, she would say something like, yes, tariffs are inflationary. If we really want to fight inflation, want to pull every lever, get rid of tariffs. But she's moved into this national security sphere. And she's been concerned. She's been talking about her concerns of what is going on with China. And that's when I think she gets a little bit more comfortable with talking about things like tariffs.
This is our favorite story to talk about, this particularly ahead of Memorial Day weekend travel. More trouble for Boeing. The company saying it will halt deliveries to China just months after a 5-year hiatus came to an end. The stock plunging yesterday, yes, again, after the CFO said the company's cash burn would be similar or worse than almost $4 billion in the first quarter. How much, Danny, is this politics and how much is this actual concern about safety?
I mean, can you imagine if all of a sudden Boeing is also now caught in the crossfires of politics, of Chinese-U.S. politics? I mean, it's like every single global trend plus your own internal problems that can go wrong. At this point, it feels like death by 1,000 cuts by Boeing. And I can't help but wonder, at what point does the U.S. government look at this and say, Boeing is supposed to be this national champion? It is so important. If it keeps going this way, at what point do we need to start talking about some sort of bailout? Maybe not in the traditional sense, but something to help them if they keep going down this trajectory.
At the same time, how about just understanding what went wrong? Understanding why we're not necessarily getting to the bottom of some of these problems. Annmarie, I do wonder what this says also about industrial policy. Basically, a state-orchestrated monopoly on an industry that is so crucial, not only to just flying around on vacation, but also to defense.
Absolutely. Boeing, and I think we've heard this a few times from a lot of our guests, too big to fail. When it comes to potentially more information, we're going to find out they will be briefing the FAA on June 4th. So potentially we'll know a little bit more of under the hood what went wrong. When it comes to China, this is a massive blow. They only started to send some of their planes back to China earlier this year after, what, a 5-year hiatus, nearly? This is a vital cash juggernaut for Boeing. And the fact that that's being stripped out, it's just yet another problem on the long list.
At least it's not a safety concern. So enjoy your Memorial Day weekend. Meanwhile, Alphabet and Meta are offering millions to Hollywood to partner on artificial intelligence. Bloomberg reporting tech companies have held discussions over licensing content in order to create better video generation software. Disney and Netflix have denied the requests. Warner Brothers Discovery is still weighing a decision. Bloomberg's Alex Webb joins us now. I love this story, Alex, because it raises this question of, with all of the artificial intelligence models, and I want to go here before we broaden in specific to this story. How much are they relying on the content generated by humans in companies that are not benefiting in any way, shape, or form economically from what the output is from the likes of ChatGPT?
The risk here is, of course, that you get a little bit of money up front, but ultimately it could come back to bite you further down the line. It could also help you in a sense if you're wanting to generate, computer special effects, VFX, essentially, with this kind of stuff. But the complexity, of course, is that, yes, there are people in a lot of these videos. How are they How are they remunerated? Are they getting additional pay from the fact that maybe their likeness is being trained on this? Presumably that's where some of the complication lies. From the OpenAI side, this is really about how do you find the next wave of data to train your next generation of, GPT-5 or whatever it might be called. Because the estimates are that GPT-4 was trained on about 1 trillion parameters, essentially 1 trillion data points. How do you find more? That's potentially the whole internet. So they're really in a search now to find new sources of data to get to that next level. And it looks as though video is going to be a huge part of that.
I'm sorry, Alex, didn't all of Hollywood literally just go on strike over this? Didn't we have actors and writers walking out? Did we not solve parts of this already?
Crucially, yeah, the actors and the writers went out on strike, but the studios themselves are the ones negotiating this part. Now, obviously, as you said, there are 2 studios that seem not to be that interested in doing it. Perhaps, of course, Disney and Netflix with a slightly stronger, tech backbone, as it were, than some of the others. Perhaps they have more of those capabilities in-house. It'd be interesting to see, though, how they square that, essentially. The deals they've signed with the unions compared to the deals that they may well sign with Silicon Valley. And it looks like a tough one to square away.
We do have OpenAI striking this deal to license news from News Corp. What do you make of that? Is that potentially a model that other companies can follow?
It certainly looks like it. I'm really interested to know what the details are of these kind of deals, because there is a view that, if you think about the media industry as a whole, where it's been in many ways, the revenue streams have really been eviscerated in terms of advertising income. The web has taken up a huge amount of that. But they haven't had many improvements on the cost side. There's a theory that then AI will improve their costs by meaning they have to employ fewer people. So it might be good news for the media industry. It's terrible news for journalists, for instance, because there may not be the need for quite as many editors. So perhaps by doing this, it won't necessarily come back to bite the likes of News Corp in the tail, because it might help them ultimately reduce their costs. That's not always worked out that way. One example that's quite useful from the past is if you think about Toys R Us, I maybe don't want to push this too far. Think about Toys R Us, and what they did is they went to Amazon, and Amazon distributed all of their toys. At a certain point, users then were going onto Amazon.com to buy toys, and the difference between Toys R Us and Amazon sort of blended away, and they were just buying toys on Amazon, and ultimately Toys R Us went under. That is the risk here, where if you are giving all of your training data to Google, and maybe there's a way you can get that back in return, it could ultimately come back to undermine your business. The details of it are going to play out in the next few years.
This is especially true because some of the big tech players have been getting into media so aggressively. This really raises the question of, A, whether they're just going to outright try to buy some of these studios, and B, just how much even more of a competitive threat are these, given the fact that essentially they're in the same game, albeit maybe coming from a different angle.
Yeah, in a sense, actually, if you're talking about this being maybe VFX or that they would be ultimately be supplying, you might then end up with the tech companies being the suppliers, but also the distributors on the other end. And in the middle, you have the Hollywood studios, if not quite producing the content, then being the sort of focal point for the content. That feels like quite an uncomfortable place to be.
Meanwhile, of course, what is content going to look like if it's just going to be people who are videoing themselves throwing bottles up in the air? Bloomberg's Alex Webb, thank you so much. No, I'm not bitter, looking at my child's feed. Meanwhile, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. The crypto sector is closing in on another milestone. The SEC signed off on a proposal from the CBOE, NASDAQ, and NYSE to launch the first ETFs for the Ether token. Fund managers still need approval from the agency before they can launch products, but investors are eager to test whether the second biggest digital asset can draw similar demand to Bitcoin. Bitcoin ETFs had their historic debut back in January and have since amassed $57 billion in assets. The Ether token is up nearly 20% this week on the heels of the news. Nomura's top executives are getting big raises. The Japanese bank more than doubled pay for its top managers as earnings rebounded thanks to the booming domestic market. Total compensation paid to the firm's 8 executives officers rose 150% to more than $28 million. The total pay for Nomura's top managers is the highest in at least a decade. And Citigroup, HSBC, and Barclays want bankers back in the office 5 days a week. The banks have been known as the most flexible Wall Street firms when it comes to allowing employees to work remotely, but regulatory changes will make it trickier for the banks to allow that, as the Financial Industry Regulatory Authority, known as FINRA, will reinstate pre-pandemic rules for monitoring workplaces in the coming weeks. That's your Bloomberg Brief. Lisa?
Yahira, thank you. Heated debate around the surveillance table about working from home. Annmarie, you want to let us all know how you feel about this story?
I just can't believe it is 2024, May of 2024, going into the summer, and now they're deciding to get people back to work. Why weren't they there before, 5 days a week?
Because they've completely reshaped their lives, Annmarie. I'm going to take the opposite on this. People have moved out of the cities. They've gone to the suburbs because they were allowed to work from home, and now they have to, commute 4 hours in? That doesn't seem nice.
And just to be clear, it's not back to work. I mean, they've been working. You think they just go home and twiddle their thumbs?
Fair. Back to the office.
Okay. I will say, though, it is sort of funny to blame FINRA for this when it's clearly maybe something else. Up next, diverging economies.
There are divergences across the different economies, which mean that there will be different monetary policy responses. But overall, I mean, we think that overwhelmingly, monetary policy settings will remain restrictive for some time.
That's coming up next. This is Bloomberg. The conversation has continued about work from home versus in the office, but we will leave it there. Welcome back. We're looking at a market that's trying to claw back some of the gains from yesterday's losses. Amazing to think that yesterday was the biggest sell-off going back to the end of April. It was an entire 0.74% decline on the S&P. On the NASDAQ, this to me is sort of shocking, Danny. It was down 0.4%. Nothing really dramatic here. And yet we saw Nvidia gain something like north of 9% for a market cap gain, this to me, of $218 billion.
Yes, and then this gets back into what you and I were talking about, Lisa, of just how much more wealthy Jensen Huang is now, and what do you do with all the money? If I can go there, what are you going to do with all that money? You're going to buy assets. And I think that's part of the reason when you see declines, Lisa, they're not as big as they were, because a wealthy person, when markets get cheaper, they're going to buy. When milk gets cheaper, they're not buying more milk. This is where the concentration of wealth is going.
Basically, asset price inflation as people deal with the fact that if you have, $30 billion, $40 billion, you're not exactly going to just buy a new yacht. You got to look a little bit broader than that. So today, maybe that's what's lifting valuations. Jensen Huang in the market buying, just saying that is not actually true. Meanwhile, in the bond market, you could see a bit of a bid in after yesterday's sell-off. And what you could see over in the commodity space is a bit of a dip. This, to me, is one of the biggest questions, Annmarie. The idea that crude's off about 0.75% as people were talking about how this might be sort of one of the bigger surprises, commodity shock. It looks like it's not on the table.
Well, we're seeing that in copper prices, not exactly seeing that in the oil prices. What we saw the lift in oil prices had to do with geopolitical risk. Some of that has now calmed down, but we still are going into this peak driving season in the summer, and people are expecting a little bit more, at least when it comes to gasoline prices. We're going to be speaking to an analyst, part of Gas Buddy, who's actually tempering some of those risks people are talking about, thinking $5 a gallon. I think he has a little bit more of a muted response to that.
I'm really looking forward to that conversation, by the way. I love the idea of analyzing some of the gas station placards to really understand the direction of travel. Under surveillance this morning, diverging economies.
Across all major economies, inflation is heading down. Of course, there are divergences across the different economies, which mean that there will be different monetary policy responses. But overall, we think that overwhelmingly the monetary policy settings will remain restrictive for some time.
Here's the latest. Traders pushing back Fed rate cut bets. Atlanta Fed President Raphael Bostic, the latest official to reiterate the higher for longer narrative, saying, quote, the sensitivity to our policy rate, the constraint and the degree of constraint that we're going to be put on is going to be a lot less. I would expect this to last a lot longer than you might expect. Meanwhile, the ECC's Joachim Nagel says the likelihood of a June cut is winning traction. Ian Shepardson of Pantheon Macroeconomics joins us now. Ian, you have somewhat of a contrarian view, and I think this is sort of interesting, where you push back on this idea that maybe this is a less interest rate sensitive economy, and that basically you're looking at something of a lag effect that's going to take effect much later. Ian, can you talk about why you just downgraded your forecast for the U.S. economy?
Yeah, we've taken a long, hard look at the operation of policy through the economy. We're particularly interested in the small business sector, which is very bank credit dependent. And bank credit growth in the U.S. is essentially stalled. It's become quite difficult and very expensive for small businesses to borrow. And that's being reflected in their surveys. Small businesses are telling us they can afford to carry less inventory. They want to carry fewer people. They're cutting back on their capital spending. And these businesses, they employ 60 million people in the U.S. They're extremely important. But in the market, they tend to be very much kind of disregarded because all the focus is on the large corporate sector, on the quoted public companies. And that means that you can get kind of a stealth slowdown in the small business sector, which goes more or less unnoticed until it spills over into things like the payroll numbers, which ultimately, is everyone's kind of bellwether of what's really going on. And payrolls have been great, but they're now starting to soften. And the small business survey from the NFIB, which has been running for decades, is telling us pretty clearly that we should expect substantially weaker payroll growth over the next few months. And I do think there's a very good chance that will start to shift opinions back towards the Fed having to do more and starting earlier.
So, Ian, how much is this sort of ratcheting down in your GDP forecast predicated on the idea that Raphael Bostic is sort of setting the tone at the Fed, that essentially they are going to hold rates higher for longer, and that is going to be ultimately what leads to 2025 slowdown that's deeper than people expect?
Well, I'm more concerned about the lagged response to the tightening that they've already done rather than the higher for longer. Obviously, higher for longer is, in my macro story is not great. But the problem for growth that I see going forward is more because of what they've already done. And I really think that markets and the Fed underestimate the length of the lags. If you look back over history, the response from the small business sector to Fed actions often takes 2 years. Now, it is 2 years now since they started raising rates. And so we ought to be seeing that softness beginning to come through. And it's right there. It's in front of us in the small business survey. So I kind of think even if the Fed starts cutting tomorrow, a slower economy is baked into the second half of this year and most of next year, more or less no matter what. But I think it's also important to draw the distinction that slow doesn't mean catastrophic or recession necessarily. It just means slower than markets are expecting and probably slower than is priced into earnings forecasts, which is where things get interesting for the stock market. Having had such a great run, we're hitting consistent record new highs. I just wonder whether the earnings numbers that rally has been based on for next year in particular are actually realistic. So there's some points of pressure here. I don't want to sound super bearish as though I'm talking about the economy really rolling over. I'm not. But I just think the scope for disappointment and the scope for the Fed in a few months' time saying, hey, actually this is rather weaker than we thought it was going to be at this point. So let's bring back some of those rate cut expectations. That seems to me a realistic, reasonable scenario at this point.
But Ian, to your point, if they cut tomorrow, it won't make enough of a difference because we're going to see the lagged effect of what happened 2 years ago. So does that mean if we do adopt the Bostic stance, that we are higher for longer, and let's say we don't get cuts until 2025, is that a policy mistake?
Yes, I think it is. I think it is. The Fed has raised rates by more than 500 basis points. The real rates are high. And the U.S. economy has no demonstrated ability in the recent past to live with real rates at this sort of level for an extended period. I mean, we did in the late 1990s, but that was during an astonishing tech boom when productivity growth was running at 3% plus. We're not in that position now. And so I don't think the economy can take that sort of level of real rates, especially because the fiscal boost that we enjoyed in 23 is now pretty much over. You can see that fairly clearly in some of the data now. So we've had these. We've also had not just the delay from the monetary policy pass-through, but also a fiscal boost as well. And so this year and into 2025, we don't have either of those supports, and the pressure from monetary policy becomes more pronounced. So delaying, if they don't cut until 25, then I'm going to start thinking hard about how weak growth is going to be in 26. Things work very slowly. We're all very impatient. Everyone in markets, media, Fed, everyone's impatient. We all want things to happen quickly. We want the Fed to hike on Monday and the economy to slow down by Friday, and it just doesn't work like that. And the danger is that we kind of forget what they've done, and then we wake up one day and go, oh, look at that, payroll growth is down to 100,000 or 50,000. Didn't see that coming.
Ian, I fear impatience is simply just human nature. You said that we're not going to have the 90s productivity boost that we did from the internet. But we have AI. Why aren't we getting another round, as Jensen Huang calls it, another industrial revolution that is going to lead to productivity boosting?
Yes, I think it is, absolutely. And I'm very much an AI bull. But I'm not sure it's going to be as transformative as Internet 1.0 was quite as quickly. With the birth of the Internet, or the more widespread adoption of the Internet in the mid-90s and onwards, it was very much being pushed from the ground up. People loved email, they loved online shopping, they loved the birth of Amazon. All these things generated immediate and obvious benefits for individuals, and so they adopted them with great enthusiasm very quickly. I'm not sure AI is the same. I view it more as being pushed down from the top by the corporates, pushed down through the business sector, rather than adopted very rapidly from the ground up by individuals. And so I'm very clearly, we've added a kind of an AI premium to growth, if you like, that we wouldn't otherwise have had relative to the interest rate environment, because we are bullish on it. But I'm just not willing yet to say it's going to be as transformative as quickly as Internet 1.0 was.
Ian Shepardson of Pantheon Macroeconomics, thank you so much for being with us. I will just say, this idea of talking about AI, Annmarie, and what the implications are going to be sometimes feels a bit like crystal ball kind of stuff.
Yeah, exactly. Also, could we pick up on the point when he said fiscal policy? Maybe it's dried up, but when you go into 2025, at some point, there's going to be big discussions on adding more to the deficit, spending more. Well, how do you pay for tax cuts? That's what the conversation is.
Well, and I'm glad that you picked up on that point, because I perked my ears up when he said that as well. And I thought to myself, what about the argument that a lot of the fiscal dollars haven't yet been deployed and still have yet to circulate through the economy? This is actually a point of big debate, and we know that other people have some views on that, too. Coming up next, Jay Pulaski of TPW Advisory, Aaron David Miller of the Carnegie Endowment for International Peace, Helene Becker of TD Cowen, and Terry Wiseman of Macquarie. You can see a lift to end the week. Maybe a little bit of optimism for a long weekend ahead. This is Bloomberg.
For this year, the Fed probably will see that slowing in inflation that it wants to see.
We're on a track to, mid-3 core inflation by year end, maybe a little bit lower. The Fed's on the right path.
Our baseline forecast is we will get one rate cut this year, probably in December.
Our call remains, as it has been for quite a while, first cut in December.
The Fed is going to hold the line on that and make sure that we're coming back to 2%. Things can downshift here pretty quickly as we go forward.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So we've had a dose of cold water to start the show. Now, let's bring in the bulls. Welcome back. This is Bloomberg Surveillance from New York City for our audience worldwide. Annmarie here. We've got Danny Berger in instead of John Ferro, who started his weekend early, which is a wonderful thing. I gotta say, we've been hearing about push back your expectations, Ian Shepardson pushing back some of the high optimism around economic growth. Danny, how much is this just that people have no visibility whatsoever into just whether AI is going to continue and how much we can continue to see this kind of lift to the market?
You saw that definitely yesterday because Nvidia had a good day and the rest of the market did not follow on. It seems to be some skepticism. Can AI lift all boats? But it also just might be, Lisa, you were talking about this, the exhaustion of the market. Recall that we just had basically every bear, save for Marko Kolanovic, finally say, you need to buy. Finally say, even Mike Wilson, I don't know what's happening in this economy, but I'm still going to upgrade my target.
Momentum gonna momentum. At the same time, you do have a question, Annmarie, of how much the Fed could curtail this party versus just continue to fuel it. We have Goldman Sachs just coming out and seeing the first Fed rate cut now in September versus the previous call of July. This just sort of speaks to the momentum in the market, which is the Fed is not going to have justification to cut rates quite as much as people thought.
Higher for longer. We've heard a lot of Fed speak this week. Yesterday, once again, we also heard from Raphael Bostic talking about how in the first quarter of 2024, inflation went sideways. That was supposed to be this moment for the Fed, this disinflationary story. It didn't quite go the same way. They need more time. But what I take away at the end of this week was not just Adam Posen, but our guest in the last hour, Lee, talking about potential, now a serious tail risk of a hike for 2025.
And you saw that in the minutes, too, that they said, look, we do need, if the data warrants it, various members said that they would look at a hike. I think one of the striking things, listening to Bostic, for example, is Oxford Economics points this out. There's a growing divergence between what regional bank governors are saying, which is more hawkish, than Fed and the governors in D.C. They are remaining more, we have this bias to cut. As the divergence grows, I wonder if Powell is going to get pushback on this cutting bias. If he wants to cut this year and cut sooner, are we going to have folks like Bostic saying, we can't do that?
Are we going to have dissent? Right now, you don't have dissent in the market. You basically have trying to claw back some of the extreme losses. 0.75% decline yesterday in the S&P. Today, you're up about 0.3%, higher at the session highs, 5,300 exactly. What an even number. Meanwhile, you do see a bit of dollar weakness in the Eurozone, a bit of skepticism about not whether they can cut rates in June. That seems to be a lock, but just how much more they can cut this year. 10-year yields basically unchanged. I mean, honestly, can we really call this any movement whatsoever? And crude dipping just a bit because, I don't know, try to understand exactly what's going on in the commodity space. Good luck, because whatever narrative it is seems to rule the day. Coming up, Jay Pulaski of TPW with stocks coming off their worst day in 3 weeks. Helene Becker of TD Cowen ahead of the busy summer travel season. And Terry Wiseman of Macquarie as rate cut bets are pushed back now to December. We begin with our top story, stocks coming off their worst day in 3 weeks despite massive gains from Nvidia. Jay Pulaski of TPW, our resident bull, writing this: Nvidia's results reinforce our recent focus on paying attention not to the news, Sorry. But to the reaction to the news, the stock's 10% gain tells us investors still underestimate the speed, scale, and scope of the AI age. Jay joins us now. Jay, wonderful to see you. Love having you in the studio. Can you talk about just how much in the crystal ball discussions that we've been having about artificial intelligence, why you think the price action shows we're just not bullish enough?
Well, I think the market tells us that, right, with the reaction to the news. The fact that the stock is up 10% on the day tells you it was a positive surprise, just by definition. And so, and it was. I mean, it's super impressive, right? I mean, you have to admit, a tripling of revenue and a sevenfold increase in profits year over year. I mean, that is just, you know, it's unheard of. And so you have a 10% move, and you don't have the rest of the market responding. As was discussed just a minute or so ago. But to us, look, we're believers, right? We are believers that every company, every government in the world is going to have to participate in the AI age. And it's either you participate or you lose. And it's that simple. And there's this concept which we believe in, which is called sovereign AI as an example, which basically states that every country is going to want its own AI. So you're just talking about a massive global explosion of demand, and you're seeing that with Nvidia.
Although you're seeing it with Nvidia. Mm-hmm. They're the winner.
Yes.
And it's a question of, can they basically rise all boats, or is it going to be Nvidia's game and party, and only Nvidia's game and party, as they potentially take share from AMD, from Intel, from a lot of other companies that otherwise might be getting some of these dollars?
Look, we're believers in what we call the pick and shovel thesis of investing in this, right? We want to be in the digital pick and shovel, and for that means for us rather semiconductors, okay? Because they're needed for the whole process. They're the winners of this, to your point. And whether, you know, X company versus Y company is a different story. To us, it's quite simple. As an investor, we want to be in the pick and shovel. So in the pick and shovel in the digital age is the semiconductor space. And then the pick and shovel in the physical space is the miners, because what's really interesting, and you touched on it with commodities earlier, what's really interesting is you're fusing the digital and physical worlds through the power demands for the data center build-outs. And again, I mean, I think the CEO of Nvidia is a guy you have to pay attention to. He is at the forefront of this. He's like Elon Musk was a couple years ago with EVs, right? He was on the front end of it, and so he was seeing what was coming. And Musk was right, okay? So now you follow the CEO of Nvidia, and he's talking about the factories of the future. He's talking about the data centers being the modern factories of our world as we move forward, and they need power. So I'll just give you an example. You know, natural gas, UNG, up 40% in the last month, 40%. Before that, it was copper. Copper, because you need copper for the electrification and the power generation, which again is going to be global. Every country, every region. So it really feeds into our tripolar world thesis of regional deepening and regional integration in Asia, Europe, and the Americas. And you see it. The Europeans are building out AI. The Chinese are building out AI. The Americans are building out AI. Everybody has to have it, and they have to have it now. And then the last point I would make is that, and I'm a believer in this idea, is that this is going to come much faster. So I respect Ian earlier, and he was saying with AI, he's not sure how it's going to come through. My feeling is that the infrastructure for AI has already been built out.
Right. Well, can I just defend Ian for a moment? Because part of his thesis was for the
finish. Usually there's like nothing but silence. I mean, wait a second. Come on. Where's John?
Yeah,
John.
Exactly. I'll take the combative view if John's not here. I'll try my best.
That never happens then. I'm like,
my accent isn't keeping up with it, but my combativeness, I'm trying, Jay.
Okay. No, I'm game.
Okay. So Ian's argument is basically that it's not going to be adopted as soon, specifically with companies. Because if you think about the internet boom, you know, everyone and their mother could simply sign up to the World Wide Web, get their own website, and then there you go, you take off. Integrating AI is a much more complicated and longer process.
Okay, the pushback is that it took a decade or more for the internet to be built out because every piece had to be created from start. The point of the AI age is that it's a layering on. The infrastructure is already built out. And so it's going to accelerate much, much more quickly. So I'm in the it's going to accelerate much more quickly camp. Ian can be in the other camp. We see how it plays out. And I go back to the idea that every company is going to have to participate in this. Every country is going to have to participate in this. And and it's a race. And so the money that's being put into this, and again, talked about fiscal earlier a little bit, interest rates, governments and companies are going to spend money on this. Companies are cash rich, governments are spending. The G7 just came out with their outlook, or the IMF, for fiscal for the next through 2029. No change. So there's no community for significant fiscal cutting. And you have the companies also spending. So and again, Nvidia is a perfect example. It increased its CapEx, it raised its dividend, it's got a stock split. So there's all these things that are happening because they're making so much money. They made $15 billion in a quarter.
Well, you had Greenspan, for example, back in the 90s, early aughts, talking about the productivity boost, the paradigm shift, basically from the internet age. Do central bankers this time around, are they aware of the potential changes to the macro landscape that you're talking about, and they need to start thinking about policy potentially differently because of that?
Yeah, that's an excellent question. I mean, we're believers in what we call the global macro blue sky outlook. So 2023 to 2027, we see a very bullish outcome. And this, what we just talked about, underpins that, because we wrote a piece a couple of weeks ago called The Age of Investment. We are in an age of investment. So 2010 to 2020 was monetary policy driven. Central bankers ruled the world. Now we're in the space where fiscal policymakers are going to rule the world. And again, it's a recognition that we need sovereign AI. We need to pay for it. We need climate mitigation. We need to pay for it. We need defense spending. We need to pay for it. And so all these things are driving, as I say, we believe an age of investment, which is going to reinforce that productivity gain, which is also being fueled by a fact that we're in a shrinkage of the global workforce, right? So demographically, we're in a whole new world, which we think is going to continue to drive automation, drive robotics, and drive the regionalization of things so that you have a whole reshaping of the supply chain, which is happening in Asia right now with China. I mean, China is basically carving out Southeast Asia, which is the fastest growing part of the world, and they're going to dominate that space. And you just look at what they're doing with EVs in Thailand and Vietnam, et cetera. They're setting up a regional production supply chain for EVs, and they're going to own that space.
Well, I wanted to ask you about China, because so much of your thesis, basically the basis is that China's still integrated with the West. What happens if it's not?
I don't believe that's going to happen.
But do people actually think we would see what we saw with Russia's invasion of Ukraine within a weekend? You had companies pulling out, their central bank assets locked.
Yeah. Well, I think, look, we've made it clear to China that we want to control their ability to rise on the tech stack. And so they're now coming back to us and saying, fine. And I think that's an opportunity, right? What we call our two tech stack thesis, right? Where the Chinese companies are going to dominate China tech stack. The American companies are going to dominate the American tech stack. That's fine. Investors have cottoned on to the latter. They haven't figured out about the former, right? So you have China tech selling at a massive discount to U.S. tech, even though the China tech space is twice as large, growing twice as fast. And so for us, we want to own the China tech space because that's where the opportunity is. And now you're seeing the same thing with EVs, right? China does not want to, China is integrated into the global trade patterns, right? They have massive trade surplus, they have massive exports. They cannot afford to be cut out of the global trade flows. And so you're seeing that in the reaction, we believe, to Biden's announcement last week about 100% tariffs on EVs. That's huge. But yet there's been nothing from the Chinese because they know they need to keep the Europeans on side.
Well, they signaled they're going to potentially have tariffs.
And they want to do it on the European side. They need to keep the Europeans on side. The Americans, it's kind of already a done deal. So they're threatening the Europeans with big tariffs on internal combustion engine European exports into China. And that's a massive market for the Europeans. And that's where the game is being played. But I believe China will continue in the economy, but the tech stack is being divided up and being closed off on both sides.
Jay Pulaski of TPW Advisory, Tripolar World Advisory, is sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Haqqis. Yahira.
Hi, Lisa. The rally in global equities is at risk of overheating, according to Bank of America's Michael Hartnett. The bank's so-called global breath rule shows that about 71% of equity indexes are trading above both their 50 and 200-day moving averages. Hartnett says if that number goes above 88%, it would trigger a sell signal. A leading candidate has emerged to take the reins at the FDIC. White House officials have held talks with Kristen Johnson, the Democratic commissioner at the CFTC, according to a person familiar. The Biden administration is aiming to quickly fill the role after former chair Martin Gruenberg said he would step down on Monday following complaints of a toxic work environment. And Tesla is hiring. The EV maker posted more than a dozen autopilot and AI jobs in the first sign of workforce growth after weeks of rolling layoffs. The company's career site has been largely empty amid the job cuts, which are expected to impact at least 10% of the company and last through June. That's your Bloomberg Brief. Lisa.
Yahaira, thank you so much. Up next, President Biden defending Benjamin Netanyahu.
We made our position clear on the ICC. We don't think there's an equivalence between what Israel did and what Hamas did.
That's coming up next. You're watching Bloomberg. Ending the week before a long weekend with a bit of relief, a bit of gains after yesterday's massive 0.75% sell-off that was the biggest in about 3 weeks. S&P futures up about 0.3%. You could see a little bit of dollar softness, a little bit more optimism about European growth, as well as more pessimism about just how much they can cut this year when I'm talking about ECB rate cuts. 10-year yields, a little bit of a bid into it, a little softness in the commodity space. Under surveillance this morning, President Biden defending Benjamin Netanyahu.
On the ICC. We don't recognize the jurisdiction, the ICC, the way it's being exercised, and it's that simple. We don't think there's an equivalence between what Israel did and what Hamas did.
Here's the latest. Israel pressing on with military operations in Rafah, announcing that 1 million civilians have been moved from the city, even as the International Criminal Court seeks an arrest warrant for Prime Minister Benjamin Netanyahu on war crime charges. Aaron David Miller of the Carnegie Endowment for International Peace joins us now. Aaron, I got to say, I don't have any clarity on how this is going to end. I don't think anyone does. Can you just give us a sense of the state of play of what's still on the table? Are we still talking about potentially ceasefire discussions?
Yeah, thanks for having me, Lisa. 9 months into this war, we're in a strategic cul-de-sac, and I don't see a clear, discernible way out. If there's any good news, and good news with respect to the Israel-Hamas war is always obviously relative, is that we've avoided a major regional escalation. That is to say, a major confrontation between Israel and Iran, or a war that would involve the United States. That seems to be something that can be managed. On the Israel-Hamas front, however, I think we're stuck. CIA Director Bill Burns is on his way to Europe in coming days to meet with the Mossad head, David Barnea, and the Qataris to determine whether or not there is any possibility of negotiating a ceasefire. But even here, Middle East negotiations always have two speeds, slow and slower. And Benjamin Netanyahu's objectives and Yahya Sinwar, the principal Hamas decision maker, ensconced in some tunnel somewhere below Rafah, Khan Yunis, neither of them see much urgency in bringing this to an end. So I think right now, again, it's likely to be a hot summer. And it seems to me that the pictures in Gaza are creating and will continue to create huge problems, humanitarian suffering, but also on the political side, with respect to the administration as it faces a very consequential election in November.
The U.S. military spokesman said that Israel is operating with care and precision. So are they carrying out this Rafah incursion the way that the U.S. is okay with?
Well, what they're not doing is dropping 2,500-pound bombs. That's the munitions shipment that the administration, one munition shipment that the administration chose to pause and or delay. The administration has created a red line, and when it comes to the U.S.-Israeli relationship, that red line often turns pink. I think the administration, frankly, is giving the Israelis the benefit of the doubt here. They're not launching a massive ground campaign. They're not carpeting the areas as they did in northern Gaza from the air. It's more limited, it's more precise, and over 1 million people have moved, but they've moved to areas, at least Al-Mawasi, Khan Yunis, where there is no potable water, there's no access to food, medical care, sanitation. So the international aid workers are obviously going to come to a much different conclusion. But right now, the administration, I think, has made a decision that the Israelis are going to do Rafah. They hope it's done relatively quickly, so then they can begin to get to the issue of what comes next.
You mentioned the ceasefire negotiations. I'm just seeing a headline from earlier this morning from the New York Times that Israeli forces recovered bodies of 3 more hostages in northern Gaza. It's devastating. We don't even know what the death count might be on these individuals. Where does all of this leave the hostage negotiations? Not just ceasefire, but actually getting those hostages out.
This is the real problem. Yahya Sinwar believes he can survive this. And the way he's going to do it is to trade time, tunnels, and hostages for what he really wants, which is a comprehensive end to the struggle and the emergence of Hamas, perhaps not in exactly the same shape as it was pre-October 7, but still influential, and with the senior leadership still alive after this war ends. And that's going to mean that he will not release, even if you agree to a limited deal to exchange the women, the elderly, and the infirm for a large number of Palestinian prisoners. That will leave him still with 50 males, both civilian and military. He's going to hold those people until he gets what he wants and hopes that pressure from the international community, the ICJ, the ICC, the Biden administration, will continue to press the Israelis to be more responsive. So again, I'll say it again, we're in for a long, hot summer.
Aaron David Miller of the Carnegie Endowment for International Peace, thank you so much. Hopefully you can join us again soon, especially as we see the international response increase with yesterday Ireland, Spain, and Norway announcing they would recognize a Palestinian state. Jay Pulaski is back with us. And Jay, with your tripolar world theme, you have an interesting take on geopolitics. You wrote this: those focusing on geopolitics is a worry for risk assets have got it backwards. Geopolitics is actually a boon for those that view the world in a tripolar thematic fashion and are thus exposed to the 3 regions and to the themes that create across and among them. Explain.
Well, I think it's just fascinating time, right? Because you listen to that and you see the pictures, you read the headlines, and you think, okay, volatility must be like off the charts, right? The reality is the exact opposite, right? The VIX stock volatility at 1-year low. The MOVE, the U.S. Treasury volatility index at a 1-year low. Crude oil, right? I mean, we're in the Middle East. Crude oil must be like over $100, right? Because we're in this crisis. Crude is down 10% over the last 3 months. So clearly, the idea, if you're investing on headlines, geopolitical headlines, you're getting it wrong. And so, you know, we're in the business of trying to get it right. And we're of the view that what is happening is really accelerating the process of regional deepening and regional integration in Europe. Europe has to scale up to build its defense. It has to scale up to create AI. In Asia, through China. China has to scale up Asian regional integration because it is being kept from expanding globally, particularly in the U.S., particularly in tech and in clean energy, right? The tech and the clean energy spaces are driving regional integration because they are no longer kind of global goods, right? The tech stack is being divided. And so you have to develop it internally. That helps develop the region. The EVs, President Biden just slapped a 100% tariff on Chinese EVs, even though they don't import, we don't import any, but nonetheless, 100% tariff. So they are creating an EV supply chain within Southeast Asia. That is integrating Southeast Asia and China. And then here in the Americas, we're still stumbling over how do we integrate outside of Mexico. We've done a pretty good job with Canada, Mexico, and the U.S. through the NAFTA version, but we haven't done much at all with South America, and that's really an opportunity. So we see things like EV tariffs. We see things like China not being able to access cutting-edge semiconductor chips as creating the framework for deeper regional integration.
Jay Pulaski is sticking with us. Coming up, the summer travel season kicking off this weekend. Helene Becker, airline analyst at TD Cowen, joins next on what you can expect when you go to the airport and try to wait in line with the other 5 million people who are doing the same. You're watching Bloomberg Surveillance. Closing out the week with a little bit of gains after otherwise a pretty stellar month, especially with artificial intelligence. Right now, what we're seeing in markets is U.S. equity is clawing back toward all-time highs with nearly a 0.3% gain on the S&P. NASDAQ about the same. Russell 2000, and this is interesting, gaining about 0.6% as people maybe recalibrate just how much the Fed really is going to cut rates and what that means for some of the most leveraged companies. When you work it through the bond market, you can see a bit of a bid into bonds, not a lot of drama, but a sense of reprieve after what we saw over yesterday's session, where you got hotter than expected, Danny, data on business activity in the U.S. plus inflationary pressures.
Yes, and it is so remarkable that the market cared more about that than Nvidia, because who amongst us this week didn't say that Nvidia was the big data point? Let's be honest, we all said it. But I can't help but wonder if some of the shift is because we just got this whole spate of Fed speak and Fed minutes that have not hawkishness, but a more hawkish tilt, talking about needing more data points from Waller before he can confirm that inflation is under control and can cut, from Bostic saying we are going to be higher for longer. Dare I say even some disagreement, Lisa, with Powell that potentially the bias isn't to cut. And I wonder if that made us more sensitive to the data.
Say it ain't so. We are just seeing this work through. Although, again, not a lot of drama, not a lot of conviction. We did see a 20-year auction go off this week, and it went off without much of a hitch, a little bit of a tail. What you could see in the currency space is a bit of euro strength. And this, to me, Annmarie, is really interesting because everyone's basically baked in a June rate cut. So we're not even talking about the sort of discussion around that, the uncertainty there. It's how many cuts they can do. And yesterday, we talked about this earlier, but I think it's worth sitting on. We talk about the U.S. is exceptional in both the inflation and strength, but wage negotiations in Europe are yielding some bigger pay raises than people had expected.
And this is what people are concerned about, an uptick in inflation. Yes, June on the table. To your point, Lisa, what comes after that? Isabel Schnabel, you mentioned her earlier, part of the ECB. This morning, she said she would caution against moving too fast on rates, which is that a question is potentially for the ECB, is it going to be one of these nip tucks in terms of a rate cut, or is it going to be a cycle?
And that's the reason why, under surveillance this morning, investors are pushing back rate cut bets to December following strong U.S. business data. Atlanta Fed President Raphael Bostic reiterating the message we've heard all week from Fed officials that the central bank needs to be patient. Jay Pulaski is still here with us. And Jay, just a beat from you on why you dismiss the idea of fewer rate cuts and potentially even the prospect of a rate hike as being damaging to the bullish thesis.
Yeah, we don't really pay a lot of attention to the Fed. I mean, I know it creates a lot of headlines and a lot of news, which we don't care about the news. We care about the reaction to the news. Sorry.
Carry on.
But
you're doing great.
Yeah, and so for us, it's a situation where we're focused on earnings, right? Earnings drive stocks, and the reality is that earnings are coming in better than expected because we have a strong economy. And as long as that's going to continue, stocks are going to be fine. And so when you look at Q1 results, earnings estimates going forward, the next 12 months have been raised to an all-time high. And so clearly the market believes companies are going to be able to continue to make money. And as long as that happens, we're going to be fine. Now, we don't have tremendous upside because we're pretty fully priced, right? So upside is earnings growth plus multiple expansion. We've had the multiple expansion. Now we're dealing with earnings growth. But what we're focused right now is on convergence and on the growth convergence. You just mentioned U.S. exceptionalism. We think that's ending. And so what we noted yesterday, not the U.S. PMIs, but the fact that the European PMIs were higher than the U.S. for the first time in a year. This is convergence. Europe is converging. U.S. up here, Europe down here, Europe's coming up, U.S. coming down, convergence. The opportunity is in the rest of the world, not in the United States.
People who work in the office and people who work at home are converging into working from the office. Citi and Barclays and HSBC are ordering more staff to return to the office 5 days a week. As FINRA industry gets set to reinstate pre-pandemic rules for monitoring workplaces that might be doing some heavy lifting, the changes will affect hundreds of employees at Citigroup and HSBC, with the changes at Barclays set to impact thousands of staff. Annmarie, our resident Get Back to Work correspondent, I gotta say, we have to clarify. It's not get back to work, it's get back to the office. I do wonder how much some of these executives at banks are thinking it is so convenient that FINRA really tightened the grip here so that we can order everyone back to the office, which is what we've been wanting to do anyway.
Yes, of course, because they don't want mass mutiny before the summer. Bank of America, JP Morgan, Goldman Sachs pretty much already have this policy, meaning we want you back in the office 5 days a week. I only worked from home a few times during COVID, and it was because I was ill or was exposed.
Here we go.
So it's 2024. I don't understand why there's even this discussion of a policy.
Well, I can't help but wonder, okay, I think it is a very convenient excuse, to your point, Lisa, that FINRA is changing these rules. But if you look at someone like Barclays, who's the most strict, Barclays is trying to cut a lot of costs right now. They want to cut £2 billion. What better way than to ask employees to get back into the office and have some potential employees say, you know what, I can't do that. I'd rather leave than continue to work here in the office. We see surveys that say that employees don't want to go in. So yeah, that's pretty convenient, too.
So nutrition methodology. Jay, are you a back to the office kind of guy?
Oh, yeah, I love The Office.
I
love The Office. I mean, during COVID, I was in the office every day. And
the hum of the computer.
Yeah, exactly.
The fluorescent lights.
What
gets
it's good for married life, right? I mean, let's face it. At least for me.
All right, let's save you here. The summer travel season kicking off this weekend with airlines balancing resilient consumer demand with ongoing fleet challenges. A Bloomberg analysis finding U.S. airlines are adding seats at the slowest pace since the pandemic. This should make for a really enjoyable experience. Helene Becker of TD Cowen expecting another strong summer travel season, adding, quote, we think we will see continued strong international travel along with higher fares. Helene joins us now. So, Helene, how miserable is it going to be over Memorial Day weekend?
We're expecting quite a lot.
I think that we're losing your sound, Helene. Let's just reestablish that. Helene Becker there of TD Cowen, and then we'll come back to you. But both of you are going to be traveling in the airports. Why do you try to brave the crowds? What's your hack to try to get around them? Do either of you have, Danny?
No, I guess I'm just a, masochist, sadist, whichever one it is. I guess, I just love pain and suffering, because clearly that's going to be the case trying to brave the airports.
I didn't actually think about it until yesterday when John texted me and he said, by the way, I know you are going to travel Memorial Day weekend. Give yourself enough time to get to the airport. It took him almost 2 hours to get out of Manhattan to JFK. And then I woke up this morning and I read Helene's note and I said, oh, wow, 2.5 to 2.7 million people will be traveling today, Friday. And I thought, oh, this is maybe not the best decision I made.
Well, it's also because of all of the upgrades to the airports. They're tearing up all of the roads. It's going to take you even longer. Helene Becker of TD Cowen, I think that we've got you back. Helene, can you give us a sense of just what this is going to mean, given that capacity is coming down, prices are going up, more people are there, and then you have, of course, Clear, which I have an issue with, basically ushering people in. I mean, how busy is it going to be?
Yeah, I think you have to give yourself extra time when you're going to the airport because the lines are going to be long. We're at record levels. The 2.7-ish million that we're talking about, there will be days this summer when we see travel as much as 3 million people a day. And the system is having a hard time already handling the 2.6, 2.7 we get regularly, let alone adding another 300,000. So I think you have to bring patience. And I say this every summer because of thunderstorms and because you never really know when they're going to pop up. If you can take the earliest flight of the day, that is your best bet.
Helene Becker of TD Cowen, thank you so much for being with us. We'll let you get off to your long weekend right now. Jay, how much do you think that the travel boom can really continue? I mean, you're talking about AI, you're talking about a tripolar world. How much are you talking about Carnival Cruise Lines?
Not enough, probably. We were invested in jets as a kind of reopening play, with jets as the ETF for the airlines. And it really didn't work, which is kind of interesting because there has been a boom in travel, but the ETF for the airlines has not really done very well. So it's not an area where we done much.
I wonder if we can kind of think about the consumer in this way, too, because we've talked about the consumer continuing to spend, even though they don't have savings, prices are up, they're still spending. Not only are they still spending with prices up, but, Jay, they are spending with the chaoticness that is going to be this travel season. The fact that there are no seats on planes, that traffic's horrible, people are even still willing to spend like that. What does that tell you about the state of the consumer right now?
Yeah, I mean, we're bullish on the consumer, right? I mean, we're at record low unemployment levels here in the U.S. and in Europe. There are fewer and fewer workers. Workers are getting paid more. When you're getting paid more, you consume. And people still want to, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend. I am happy to say I'm not traveling anywhere. I wish you all well making that trip. I'm going to be in the office, exactly. Lisa knows me too well. We've been around together too many years. So I'm just going to be sitting at home and trying to relax in the city. But look, we're bullish on the consumer globally.
Yeah.
We think there's a fully employed workforce, wage gains, and we're not believers that the consumer is going to create a problem, either here, Europe, or elsewhere in Asia.
Well, first of all, Jay, let me say I'm incredibly jealous of your weekend. I wish I had made that decision as well. I'm currently regretting it. But we were talking about this during one of the breaks, the confusingness of the data, because it is this K-shaped economy, because you have this huge bifurcation. So what do you use to get a sense of the consumer when maybe the headline data isn't telling you everything?
No, I think that's a great question. And we look at many different things, right, through our work and talk to a lot of different people. And essentially, we want to have a framework, right? And our framework is the tripolar world. And we have a view as to how that's materializing. And we put out in our 2024 outlook 4 macro surprises, right? Lower inflation sooner than expected. That's happened everywhere but in the U.S. Rising productivity, also in place. A return to stability, which we see with the volatility indices descending, and then early cycle. We believe we are in an early cycle global economic recovery. Most people talk about us being late cycle going into recession. That's been the thesis for the last 18 months. People still have it, even though it's been wrong for 18 months. So our feeling is that we're early cycle. We're in the beginning of a manufacturing pickup. We're in the beginning of a CapEx boom. To build out all the things we spent time talking about earlier this morning. And that, for us, leaves us constructive. So we don't sweat the details. We're not sweating the Fed cutting, June, September, whenever. We're not sweating those issues. We're focused on the fact that earnings are solid, and that gives us the comfort to continue to stay fully invested.
Are you sweating what the CEOs are saying on earnings calls? Target, Walmart, Starbucks, they are seeing a more discerning consumer. Consumers who are saying inflation is biting. Walmart, I'm going to trade down.
No, actually, we're not, because we're not invested in that part of the marketplace, right? I mean,
but
we have the opportunity.
Say about the consumer, though. You don't see any cracks in this consumer?
No, I mean, we look at things like household net worth at all-time highs. We look at household net worth in liabilities versus disposable income, things like that. They're all very, very benign. There's nothing that suggests we're in any kind of approaching a cliff for the consumer. And so, to us, we're focused on the pick and shovels in the tech space, the miners. We're very bullish commodities. We're double-weighted commodities. We're completely underweight fixed income. We have zero treasury exposure. And we've had zero treasury exposure for going on a couple of years now. And we're overweight equities, and we're triple-weighted right now in emerging markets. So triple-weighted versus our benchmark. We're very big believers in China tech. We're believers in Poland for European integration, Vietnam for Asian integration, Mexico for the Americas integration, and we're in copper miners, uranium miners, gold miners, natural gas, and these things have been working. And we think there's a real imbalance between how fast we want to build out data centers and how fast we can build a copper mine. And so what pulls those two things together is price. And so we're in the Jeff Curry camp, right? Copper is, like he just said, and he's a very respected guy, the best trade he's seen in his entire career. That resonates with us.
Jay Pulaski of TPW Advisory, thank you. I'll get you together with Dan Ives, and it'll just be an explosion of bullishness. It'll be fantastic. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Treasury Secretary Janet Yellen acknowledging that persistent inflation remains a problem for many Americans. Speaking at the G7 finance meeting in Italy, Yellen said that wage increases in the U.S. are not keeping up with the high costs of food, rent, and mortgages. The comments come as polls continue showing Biden struggling to win over new voters. Yellen is set to meet with ECB President Christine Lagarde later today. Alphabet and Meta are offering millions to Hollywood studios to partner on AI. Bloomberg is reporting the companies have held discussions with the studios to license content for the tech giant's AI video generation software. This is a technology that can create realistic scenes from a text prompt. Disney and Netflix have declined to partner with the companies, while Warner Bros. Discovery is still weighing a decision. And Nvidia CEO Jensen Huang had a good day yesterday. His net worth grew by almost $8 billion to $91 billion as shares of Nvidia rose 9% following better than expected quarterly results. A majority of Huang's net worth comes from his stake in Nvidia, the company he co-founded back in 1993. According to the Bloomberg Billionaires Index, Huang is now the 17th richest person in the world. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. I love this idea. And I think, Danny, you nailed it, which is what do people do with that kind of money? They're not going to go just, buy a lot of apartments. I mean, they're going to basically funnel back into stocks.
And that's why this time is different in this market, that even if we get some hiccups in this global economy, even if inflation continues to be a problem, assets can do well because they are bid up by the Jensen Huangs of the world that have literally nowhere else to put their money.
Because the rich gonna rich. And this is the reason why the banking industry is definitely shifting around a bit, too. Up next, the case for higher for longer.
We need to rebalance the U.S. policy mix over time. Our call remains, as it has been for quite a while, first cut in December.
Next, you're watching Bloomberg. Welcome back. This is Bloomberg Surveillance, closing out the week with some gains. We see about the S&P 500 up close to those all-time highs, once again up about 0.25%, 52.99 near that 5,300 around mark. Meanwhile, a little bit of a bid in Treasuries fades. It is now a little bit of a sell-off. It's basically no action whatsoever on the day before Memorial Day weekend. Under surveillance this morning, the case for higher for longer.
Basically, the case is we need to rebalance the U.S. policy mix over time, and that means monetary policy less restrictive than it's now. We don't need to do it now, but we probably will have to do it in the coming years. Our call remains, as it has been for quite a while, first cut in December.
Here's the latest. Treasury yields jumping yesterday after strong U.S. business data prompted traders to push back Fed rate cuts. Terry Wiseman of Macquarie writing, the fixed income market already believes that R-star is higher than the Fed's current estimate. But should the Fed signal in June that its estimates of R-star are moving higher, it could be effective monetary policy signaling that takes the stock market lower. It could take longer-term U.S. Treasury yields higher, too, perhaps back to 4.75%. Terry joins us now. Terry, we were talking earlier with Lee Farage of State Street. He was talking about the idea of a potential rate hike back on the table the longer that inflation just seems like a hard beast to kill. Do you agree with that?
Well, in probabilistic terms, no. Which is to say that I don't think we're going to get a rate hike. I would assign a lot less than a 50% chance to seeing that happen between now and, say, the end of the year. Is it possible, though? Yes, anything is possible. And if you read the minutes carefully that came out for the May 1 meeting of the FOMC, you did clearly detect in the transcript that there were some members of the senior Fed's policy officials that would contemplate or consider raising rates again. But they also said that it would have to be under the right conditions. And I think those right conditions mean that we would have to see inflation accelerate from here. I don't think that's going to happen. I don't think the Fed thinks that's going to happen. There's a basis for believing that the next few months may see somewhat softer inflation in the U.S.
Okay. To me, the interesting point about your theory is that you were focused on the long end of the yield curve. And a lot of people have been saying that the Fed's been keeping rates high, yes, on a relative basis. But they've actually been somewhat stimulative when it comes to longer dated treasuries in terms of some of its repo lines and some of its other balance sheet policies, particularly after what happened last March. Why do you think that that's going to end? Why do you think that the long end could suddenly see something that it really hasn't seen for a sustained level so far in this cycle?
Well, it's going to require a different signal from the Fed, especially in respect, not so much of the long-term yield, but in the long-term outlook for short-term yields. And there's a little bit of a difference there.
Happy Friday.
Of course, without getting too technical, what the Fed may be trying to tell us, or certainly the hawks at the Fed are trying to tell us, is that do not expect that short-term rates will find an equilibrium in the twos again. In other words, 2 point something. There's probably still a large part of the marketplace that believes that eventually we're going to get back down to a 2% policy rate, but the hawks don't believe that. And I believe at least the hawks have a sound basis for that belief, which is that there are, in the long term, structural trends and tendencies in the U.S. and global economy that are inflationary. And therefore, that last mile of getting from 3% inflation to 2% will be tough, but it'll only be made even tougher if you reduce rates, let's say, below 3% ultimately. And I think that's the thesis. And eventually, when the market recognizes this is the way the Fed is thinking, and it's not just a minority, but potentially a majority, the long-term yield will rise to reflect that.
What you're saying reminds me also that we came into this year with many people not just saying it was the year of the bond, but also that it was the year for curve steepeners, that this was going to be the time that finally we got out of a negative yield curve. It didn't happen because you have a front end that's scared of the Fed, and then you have a long-term end reflecting what you're saying and also scared of the economy. So if what you're saying is correct, are you loading up on steepeners again?
Yes. Look, the normal, typical shape of the yield curve should be upwardly sloping, okay? There are many distortions that one can point to, some, maybe dating back to COVID, others dating back to the uncertainty with regard to Fed policy that are making that curve inverted right now. But if you believe that the normal shape is upward sloping, you should consider that right now you would not want to be invested in the long bond. There is an implicit handicap there if you're buying the bond at 4.4, 4.5%. When short-term yields are high, likely to stay high, and then when you consider all of those long-term structural drivers of inflation in the economy.
Well, Michael Hartnett over Bank of America, in his note this morning, said essentially that U.S. Treasuries are 48% of the global government bond market. U.S. credit and stocks are more than 64% of their global markets. And so says that policymakers know that the U.S. is too big to fail. So they are setting policy knowing that recession is more consequential than inflation. What do you think of that?
Well, that may be the case, but the policy that we're talking about here is policy mainly that impacts the short-term rate. The long-term rate is determined by the market. The short-term rate is managed by the Fed, effectively, and other central banks. So although it's nice to believe that policymakers have a say directly over the long-term yield, in fact, they do not. That is determined by the actions of traders and economists and analysts and like myself, with very little reference most of the time to what the Fed is doing on the short term of the curve, short part of the curve.
I'd love to get your take on the consumer, because we just heard from Jay Pulaski, who says he's not listening to the earnings calls when Walmart CEOs, Starbucks, Target talk about the fact that consumers are becoming more judicious in what they decide to buy. Are you seeing cracks on the consumer side?
Not really, certainly not yet. I would argue that the consumer is one of those structural tendencies or trends, longer term in the economy, that is inflationary, but not necessarily for cyclical reasons, not necessarily because the Fed is keeping interest rates lower than it should be. The reason is demographics. We have a baby boomer, a cohort that has been made fantastically rich by the stock market over the last few decades. And now they are retiring, and they are no longer working, which means they're no longer producing, but they still want to consume. Right? And that is inflationary. It adds to the imbalance between supply and demand in the economy in the direction of too much aggregate demand and too little aggregate supply. And that's going to continue to roll on for the next few years. Eventually, it'll reach me. And I'll be consuming more than I'm making. So yeah, that's what's happening. And that's a structural theme that one has to consider when one is looking at things like the long-term bond yield.
Terry Wiseman of Macquarie, thank you so much. Have a wonderful long weekend.
Thank you.
I hope you enjoy it. Coming up, we've got Colin Graham of Robeco. We've got Patrick DeHaan of Gas Buddy on just how expensive it's going to be going forward to drive around. Kathy Bostancic of Nationwide and Alberto Gallo of Andromeda. Honestly, to me, one of the big takeaways has been just the confusion, Annmarie, in classifying whether the consumer matters, how much they've been weakening, and really, are their savings finally up? Is their credit quality deteriorating? What's going on?
Well, I think you go back to what Mohamed El-Arian said. You have to listen to the earnings calls and what CEOs are saying about inflationary pressures. And in that sense, I think it was one of our guests this week, Drew, talked about latte shock. That's what the consumer is feeling.
Really? It's all about the lattes? That really resonated with you.
Well, because they are expensive.
Only the lavender ones.
Well, honestly, do you like lavender lattes?
No, that's not for drinking.
I can't really.
It's for smelling.
All right. Well, we have not that conversation coming up next. We've got some economic data as well. Right now in the markets, you can see a little bit of a lift following yesterday's massive sell-off. It was not massive, but it was the biggest one in 3 weeks. Up now, session highs 53.02. This is Bloomberg.
As an asset allocator, I don't think I've ever been so interested in stocks.
Corporate health looks very good right now, and we do feel very good about that.
The momentum continues to get even stronger than it had been earlier this year.
Everybody is trying to get into the AI world. The question will really be who ends up using it better.
Get the popcorn out, because this AI revolution in 1995 moment, it's just starting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
30 minutes until economic data, 90 minutes until the start of trading. We've got 120 minutes until the University of Michigan survey, and we've got 340 minutes until the close of the bond market. Welcome back. This is Bloomberg Surveillance on the day before a long weekend. Annmarie Hordern is here. Danny Berger is putting up with us. You've already 2 hours in. Thank you so much for doing this with us. And John Ferro is on a well-deserved break. To me, very much front and focus is this question of how much are we seeing inflation remain sticky? And frankly, Danny, how much does that challenge the thesis that stocks can keep riding through it?
If you are of the opinion that all that matters is that there's economic growth and that's why inflation is higher, then it doesn't matter and stocks can keep rising through it. That was Jay Pulaski's view. But Lisa, I think it was interesting because in that he basically said, okay, but our upside is limited because you have rallied so much. We, to a large extent, have already priced in the good earnings. So how much better does it need to get to actually be able to say that the inflation doesn't matter?
Annmarie, who do you think is going to care more about the University of Michigan sentiment survey? Do you think it's going to be traders? Do you think it's going to be Joe Biden's campaign?
I think it has to be the Joe Biden campaign. You saw Janet Yellen speak about inflation just in the last 24 hours. She's in Sintra. She sat down with the Financial Times. She talked about, yes, we do know prices are going up. It's affecting people at the grocery store, their rents. If you're young, trying to get on the housing market, she says, yes, we take this into concern. And this is what continues to dog the Biden campaign in the polls. Number one issue is the economy. When you try to dig down, what's that issue about the economy that really bothers you? Student loans, cost of goods, housing market. It's cost of goods. It's inflation.
Which raises this issue. They feel bad, and we've continued to say this, but they keep spending, whether it's a lavender latte, whether it's whatever it is, maybe not as much there, but in other places to travel where you guys are going to be competing to get on the security line this weekend. But Danny, I do wonder just whether we think about the Ian Shepardson view of things, which is basically long and variable lags still are in play and are going to hit hard, or whether we go to the Jay Pulaski view of the world, which is stop being ridiculous. It hasn't happened, so why are you considering to believe in something that seems like it's just not reality?
Honestly, those two views just underscored to me how confusing everything is right now, how confusing the data is, that very logical, smart people can look at the same exact set of data and come away with exactly bipolar views. But that's what we're seeing throughout this market, whether to your point, Annmarie, of trying to understand the consumer. The data does not make sense, and I can't help but wonder if this data is equipped for the modern world that we're living in, if the measures we use now can actually help us figure things out.
One aspect of the data does make sense, and that is near record highs on equities. And that's what you can see again this morning as people do bid in, given the sell-off yesterday. Maybe that was a buyable dip, 0.75% decline. Hey, at least it's something. 5,300 on the S&P ahead of the open in about 90 minutes time. A little bit of dollar weakness, euro strength, 108.43 as people look to this idea that maybe the ECB is not going to be able to cut rates as deeply as some people had expected, given all of the strength. 10-year yield just kind of wavering around that 448 level. In the crude space, kind of clawing back some of the earlier losses, now down just 0.1%. Coming up, Rebecca's Colin Graham as traders push back rate cut bets. Patrick DeHaan of Gas Buddy, as a record number of Americans plan a road trip this summer and are going to be checking out those billboards to see just how much it's going to be to fill up their tanks. Nationwide's Kathy Bostancic reacting to data and looking ahead to next week. We begin with the big issue. Traders pushing back expectations for the Fed first interest rate cut amid a pickup in inflation. Rebecca's Colin Graham saying this: many U.S. consumers are immune to interest rates. The U.S. economy, driven by a resilient consumer, has been the most important source of growth in the global economy post-COVID. Colin joins us now. Colin, thank you so much for being with us. You know, Annmarie's been asking this question consistently for the past couple of weeks, and honestly, it's an important one. Why is it not that we're seeing cracks in the consumer when you take a look at some of the earnings that we've seen from the likes of Starbucks, from the likes of some of the from the retailers? Why are people so quick to dismiss that and say, it doesn't really represent something broader?
I think you've seen the US consumer actually deleverage since the global financial crisis, and they have a propensity to spend. So any fiscal stimulus that comes out of the government gets spent. So therefore, it's not saved and it's spent. And I think you've hit that nail on the head here when you're looking at, going to Starbucks or Nike or whatever versus travel in terms of going away, doing the experiences, doing the services. And I think that is the sort of the dilemma or the split that people are really trying to understand here. And it's not surprising you've seen earnings a bit weaker here and there, but overall the US consumer is in a job, its wage growth's at the median running higher than inflation, so therefore they feel better, and so therefore they'll spend.
Colin, which side do you weigh in on? The Jay Pulaski view of the world, which is everything is awesome and we're in an early stage of a recovery that's going to broaden out? Or are you in the Lee Farage camp where suddenly we're talking about the prospect, maybe albeit small and a tail risk, of a rate hike, maybe even early next year in the face of strength that's going to torpedo certain valuations?
I think that whether it's one rate cut down or one rate hike up, I don't think it really makes that difference. We're not going from 0 to 5 again. We're not going from 5 to 10. So from that perspective, a little bit up, a little bit down here, I think is part of the just finessing the policy. I don't think it's really going to change anything. I do subscribe to parts of what Jay said earlier in terms of the emerging markets, the turning around in the manufacturing, the commodity side of things, but I sort of agree that valuations are too high at the moment, and so with the liquidity injection we saw during May, you can see why equities have jumped so much and recovered from their April drawdowns.
Colin, if it is just more of a finessing, of a mid-cycle tweak, a cut here, a hike here, you wait a month, maybe you don't, then does the big deal we're making about Europe in terms of rate differentials, that if they go first and they continue to go, that it's going to be a problem for the euro, is that not the case this time if we are just talking about finessing?
Yeah, I think the path of ECB rate cuts could be difficult. There might be one, possibly two, but once you start getting into 3, 4, you have to think there's something bad going on in the economy, and that's when the euro will be hit. And if the euro gets hit, then actually the imported inflation will actually start to push inflation numbers back up. So therefore leaving the ECB with a dilemma there, and I think the ECB is in a more difficult place than actually the Fed at this particular point.
So if they are in this dilemma at the moment, Colin, do we need to start talking about euro parity again, if that's where this is going?
I think if they say that they're going to cut rates and continue to cut rates, I think that will lead the euro to go lower. So we could start easily talking about parity, because I think that if you see big rate cuts, then there's something wrong with the economy. And therefore, then you start to see growth falling, and possibly inflation, and therefore that will cause the currency to lose one of the supports, which we're seeing at the moment with the global manufacturing recovery and the recovery in Europe. You're actually seeing that quite clearly now. You saw the banks report very good earnings. So, the European economy is actually doing okay, and therefore I can't see why they would want to do more than one rate cut, possibly two.
But you said earlier that the ECB is in a worse place than the Fed. So how then is the European economy doing better than you were expecting?
Well, this is from the manufacturing side. So the manufacturing sector has been in pretty much a recession for the last 18 months, and you're beginning to see that bottom out. You saw that in the US data yesterday with the manufacturing PMIs turning around as well. So Europe is very much an open economy and very much more a manufacturing economy than necessarily a service-led economy and a consumer-led economy. So they really need that growth in order to get the German people to feel better about spending. So it really comes from the manufacturing side and the industrial production side.
So Colin, what's your biggest conviction, highest conviction bet right now?
I still think emerging markets over the next 12 months should outperform. The start of the year we talked about China, and that was my surprise for 2024 that Chinese equities were going to be the best performing equity market this year.
Colin Graham of Rebecca, thank you so much for being with us, and have a wonderful long weekend. Although, is it in London? Do they do Memorial Day? No. You both have lived there.
No.
No?
No, but they have enough bank holidays, so they're fine. They're fine.
It's so sad, though, because you don't even get like a reason for it. It's not Memorial. It's like, hey, you just get the day off.
I actually think it is their May bank holiday this Monday, so
maybe
everyone gets a holiday.
You get a holiday. You get a holiday. You get a holiday. And you're very happy about it. Let's get on right now an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hawkins. Yahaira.
Hi, Lisa. Elon Musk's SpaceX has initiated discussions about selling existing shares in a deal that could value the company at $200 billion. That's according to people familiar with the matter. The valuation would be a premium to the $180 billion it fetched in its previous tender offer. SpaceX is already on par with some of the world's largest publicly traded companies by market cap. Vice President Kamala Harris is gaining popularity in key states. The latest Bloomberg Morning Consult poll says 48% of swing state voters say they trust Harris to step in for President Biden if he can no longer serve. This is the highest reading since the survey was first conducted back in October and comes after a series of high-profile events Harris has held around abortion. A new development in the Ozempic revolution, the New England Journal of Medicine said that patients with kidney disease caused by diabetes were 1/5 less likely to die of any cause during the study if they took Ozempic rather than a placebo. The findings add to evidence that Novo's treatment for diabetes and weight loss can help with a host of interrelated conditions around obesity. One nephrologist said that the findings will likely change the way kidney disease is treated. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And it's definitely got a lot of insurance companies quaking in their boots because basically they're going to have to pay for it if essentially it can solve all of these other problems. I got to say, Danny, what happened to this sort of obesity sort of pandemic over that people were talking about, that all of these weight loss drugs were going to ignite massive gains akin to artificial intelligence? I mean, Novo Nordisk is only up 34% this year. That's nothing compared to Nvidia.
It's true. 34%. I mean, it's still not nothing, Lisa. But I guess, it's the supply-demand thing. There's a lot of demand for it, not lots of supply. Maybe if insurers approve it because of the kidney disease thing, maybe, that solves some things.
That's definitely what people are looking into. That maybe you're going to end up with this idea that they're going to have to cover it if it basically solves everything.
Yeah, does insurance have to step in? The government might have to have a say on this as well if it comes down to things like Medicare, Medicaid. But if it's going to be used more than just weight loss, then insurance might have to pay.
We're all going to be on it one day, it sounds like, the way that this is going.
I don't think so.
You get a big shot. You get a no, not necessarily. Up next, the summer travel stress test for consumers.
People still want to, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend.
That's coming up next, and neither of you are needed in any capacity. You're watching Bloomberg Surveillance. 5,300 back there. We're definitely climbing toward all-time highs once more. Welcome back. This is Bloomberg Surveillance on the day before a long weekend. I'm sure all of you are glued to your screens, just riveted and counting down the seconds until you can leave for your long weekend. S&P futures just off some of the session highs, up 0.25%. A little bit of dollar weakness across the board. Not a lot of drama. Everyone's just sort of hoping nothing really happens to really draw them back to the office. Under surveillance this morning, the reason why people are looking forward to the weekend, the summer travel season begins.
We're at record low unemployment levels here in the U.S. and in Europe. There are fewer and fewer workers. Workers are getting paid more. When you're getting paid more, you consume. And people still want to, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend.
Here's the latest. It is the busiest weekend of the year for road travel. A survey from Gas Buddy saying 60% of Americans are planning a road trip over this Memorial Day weekend. Other people are going to be flying and they're going to be going to the airport. Patrick Jahan of Gas Buddy writing this: while Americans gripe about the cost of gasoline, it doesn't seem that too many are going to be deterred from hitting the road. Great news for those who are planning to travel. Motorists are likely to see more stations lowering prices to $2.99 per gallon or less as the summer wears on. Patrick joins us now. Patrick, riddle me this. What happened with all the people saying we didn't have enough refineries? Yes, we're pumping 13 million barrels a day, but there are supply cuts coming from elsewhere. Gas prices are going to skyrocket during the busiest driving season of the year. Why do you think that's not true?
Well, we've gotten a lot more breathing room here over the last 6 to 12 months or so. It hasn't been U.S. refining capacity, but there have been some global additions. I would point out, though, I think this year in kind of the post-COVID world, a lot of Americans hit the road in 2022. That's why gas prices did skyrocket over $5 a gallon. Things cooled off last summer. A lot of folks hit the road last summer, but I think this summer is also going to skew international air travel. TSA reporting records. Our gasoline demand data, I just looked at it, did shoot up for yesterday, about 11.7% rise from Thursday prior. So we are starting to see Americans fill their tanks. But I don't think gasoline demand is going to be at record levels, though a lot of folks are going to be hitting the road or traveling. They may be doing so via air. Of course, the EV transition is part of that discussion as well, although that has slowed down. No matter, a lot of Americans hitting the road this Memorial Day.
So, Patrick, let's just sit on that for a second, because some people do say this is the sort of understated aspect of demand in the gasoline market, that more people have more efficient vehicles, even if it's not electric vehicles. It could be hybrids. It could be just cars that get better mileage for their gas. How much is that a factor of demand for the gasoline?
Well, probably a notable one. You talk about the EV transition where people completely ditch gasoline. That's probably a small but rising part of the conversation, especially in areas like California that are looking and pushing incentives for Americans to move into those vehicles. But as you mentioned, look at manufacturers, how they've skewed to plug-in hybrid electric vehicles or mild hybrids. A lot of that. I mean, $5 gasoline. Americans, when they buy a new vehicle, often have the memory of those gas prices. And a vehicle, buying one is a long commitment. And so a lot of Americans have been looking at some of those more fuel efficient options in the last couple of years. Keep in mind, too, that like myself at this moment, work from home is still a thing. A lot of Americans still doing that. And that's probably where some of this drop in consumption is coming from, the fact that it's been a very slow return to the office.
If we start inching towards $5 a gallon, what do you expect the White House to do? You know how important gasoline is to them. You have been a guest at the White House when Ron Klain was chief of staff, and they were obsessed with this when prices were spiking. What do you expect the administration to do?
Well, they don't have a whole lot of levers. I know that every American thinks that the White House has some sort of huge lever in the White House, the Oval Office, that controls prices, but there's not a whole lot. I mean, the president can offer things like unleaded 88 or E15 all summer. That's what he's done, right? That's going to be available through waivers via the EPA. But the only other thing really is just to kind of hope and pray that hurricane season isn't going to be as bad as they expect. Now, again, some of the issues with summer gasoline prices come from the fact that the U.S. is very fragmented when it comes to these summer blends that everyone's heard of. To give you one example, refineries have been struggling here in the Chicagoland area. Chicago uses reformulated gasoline, which is different than downstate Illinois, which is different than Detroit. So there's all these different localized blends. If the federal government wanted to do something, they could really simplify the system. I mean, California and Arizona both have their own different blends. It's like you get a blend, I get a blend, everyone has different blends, and when refineries go down, that becomes problematic to supply all of these various blends. So aside from that, I mean, the White House already shutting down now the Northeast Strategic Gasoline Reserve. Of course, that was mandated by Congress. Trump tried to do it in 2020. But even that is not going to really move the needle. So the White House is just kind of along for the ride here, hoping that OPEC will continue the status quo and oil prices will continue to be under 80.
What do you think could be a bigger impact this summer? Natural disasters or geopolitics, given we have two hot wars, one in the Middle East and, of course, in Ukraine?
I think without a doubt, I think the weather is going to be a bigger factor. The Middle East, I mean, Iran now has a lot of its own issues with the helicopter and elections coming up. So Iran and Israel, I mean, that was something to watch, but even that didn't really move the needle. I think oil markets are kind of stuck in this depressive state, right? OPEC is now saber rattling. They're going to have a meeting virtually, and oil prices this morning still under $77 a barrel. So I think weather's the big wild card. Nobody controls it, right? Even the Middle East, there's some certainties, even if they're unreliable. Mother Nature's just completely question marks all over it. Will we get a major storm in the Gulf of Mexico? Is it going to be a Harvey and dump, 1 to 2 feet of rain on refineries, shutting them down? I think that's really the thing for this summer that keeps me awake. Will hurricane season turn into the dread like everyone's talking about? National Weather Service yesterday issuing its most active early forecast ever for hurricane season, and those sea surface temperatures are rising, and it's quite concerning.
I'll tell you another thing that's keeping people up at night, Patrick, who are on their way to travel. It is the headline after headline about Boeing and concerns about that plane. You couple that with what we're expecting in the airports. It's going to be extremely busy. It's going to be chaos. Do you see any of that translating into folks more wanting to travel via their car rather than going to the airport?
Well, we know Americans have an affinity for their cars, and keep in mind also the headlines over that Singapore Airlines turbulence is probably getting a lot of attention as well. But keep in mind, once you buy those tickets, especially with some of these fares now, you're stuck with it. Oftentimes airlines now have those restrictions back in place. But I think to your point, America still has a love obsession with the fact that cars are mobile. You can leave whenever you want. You don't have to do security. So, yes, I think Americans, if anything, that haven't yet figured out their travel, they'll probably skew more to using their vehicle, especially as summer wears on. Gas prices, we expect, are going to be highest on Memorial Day, lower for July 4, and pending Mother Nature, even lower for Labor Day. So I think that's probably going to open the door for some of those last-minute road trips. As our survey points out, Memorial Day is the most traveled holiday. But if you look at July 4 and Labor Day, plenty of people are hitting the road. They just haven't planned it yet. And those folks that haven't planned ahead are probably going to gravitate towards gasoline consumption. So we could see a little bit of a rebound there, to your point.
Patrick, can you put some numbers on that in terms of what price you expect things to be just heading into Labor Day?
Again, a wide range of possibilities. We have the national average potentially as low as even $3.29, but as high as $3.90. August and September are the months that we have the least certainty out of all 12 months that we put our forecast together. August is really up in the air. Why? Because you get a lot of late summer demand. Will we get hurricane season that's more active before? If we don't get any hurricanes, we're probably going to skew to the lower part of that forecast range, maybe 330 to 350. But we've all seen the impact that something like a Hurricane Harvey can have on gasoline prices. And we could skew to the 380s and 390s, or like last year. You'll remember that a spat of refinery issues hit both the West Coast and the Plain states all at once and caused a late summer surge in the national average to $3.90 a gallon. So we're very mindful of what happened last year.
Patrick, we just have about a minute left. There is a theory that the president can just empty the Strategic Petroleum Reserve and drive prices down. Is that valid?
Well, I mean, that's what so many Americans forget about. We all stare at the price of oil, right? There's a lot of couch analysts who say oil is this, gasoline should be that, but we all forget about the middleman, the refinery, the thing what we've talked about. COVID still, remember, has reduced refining capacity. So you can have all the oil in the world. The SPR could be full. You could release the whole thing. That doesn't translate to usable products like gasoline, diesel, and jet fuel. It still is subject to that bottleneck of the refinery. So that's where the president is relatively powerless. This oil reserve is not going to necessarily equate to lower gasoline prices. And keep in mind, too, when it comes to that gasoline reserve, that thing costs $200 million to maintain over the 10 years it's been in existence. The cost of that gasoline, the street value today of that gasoline, $103 million. So it's probably a good thing we're shutting down that gasoline reserve. I would point out that's something that even President Trump tried to do back in 2020.
Patrick DeHaan of Gas Buddy, thank you so much. And this is really one of the key metrics that people are looking at to consumer spending, because essentially the higher prices go on gasoline, typically the less disposable income in a lot of families, and vice versa if prices go down. Coming up next, breaking durable goods data nationwide's Kathy Bostancic and Alberto Gallo of Andromeda Capital. And we are still talking about work from home versus the office. Welcome back. This is Bloomberg Surveillance with a lift to equity markets to finish the week after yesterday's declines. We do see retracing some of the earlier gains, but still around that 5,300 round number. NASDAQ futures up 0.2%, just minutes away here from durable goods data. Why does it matter? Well, it's the latest read on maybe airplane orders, among other things, but also at a time of better than expected data more broadly in the manufacturing sector. Michael Mckee of Bloomberg, our own economics and policy correspondent, here to break down the numbers.
Well, surprisingly better than expected, because Boeing had not done well in the prior month in terms of orders, but their orders don't always match up. So we get a 0.7 gain for durable goods orders in the month of April. That's the preliminary number, after a 0.9 gain the month before, and it had been revised significantly lower. Durables ex transportation up 0.4%, and capital goods ex aircraft ex defense orders up 0.3%. That's the one that matters to economists and the Fed, because that goes basically into GDP, up 0.3 after a negative 0.2% in the prior month. Shipments for capital goods during April up 0.4, which is going to be an addition to GDP for the second quarter. So we have good news there as well.
What's interesting to me is that you actually are seeing something of a reaction in bond markets, considering the fact that this isn't often that significant of a market-moving event. I know you're laughing, Mike, but I'm not wrong. If you take
I'm laughing because I think everybody is there. They had to come into the office before they head to the Hamptons, and so as long as we're here, we're going to trade on something.
Well, there we go. They're trading on it, and it means selling off treasuries. Two-year yields, 4.95%. Not necessarily a huge dramatic move, but direction after being directionless. Basically, another better than expected print after yesterday's business activity data. Mike, can you just look at that data for a hot second and just give us a sense of why people were so surprised? Business activity accelerating at the fastest pace in 2 years, with goods prices really accelerating much beyond people's expectations.
Well, that's it. I mean, people are looking for direction, and they're trying to figure out where the Fed is going to go. And there's been all this talk of the economy slowing, and then you get these numbers that say the economy is going to be a little faster. And in the absence of anything else that's going to drive the bond market, people reacted to that. What was interesting is the reaction in the equity markets to what was happening in the bond markets, because the equity markets have largely ignored the economic data, whether it's going up or down. Equities have just been going up, and now all of a sudden they're taking a hint. Is this the start of a change in thinking about the economy and what profits will be going forward?
Well, to that point, stocks dropped like 5 points. Now they're back where they were before this data came out. So stocks this time around apparently don't care, Mike. But I wonder, when you look at that, you look at durable goods orders, better than expected. When you look at the data yesterday, better than expected. You pair that with some of the weak survey data for small businesses and businesses in general. Does that make us say, maybe we need to discount that weaker data for surveys a bit more?
Well, it just makes it harder overall for the Federal Reserve and for people on bond trading desks to get a clear picture of where things are. The soft data has been soft, although the small business numbers went up a little bit last month. We'll see. We get Michigan sentiment today. We'll see if that changed at all. It is perhaps possible that gasoline prices falling, as your previous guest was talking about, and the weather turning nicer may have people in a bit better mood about the way things are going.
And buying airplanes, maybe. I will just say this. We are looking at some serious downward revisions to the prior month's data, which might be why you see, Danny, some of the tempering of the initial expectations of this just sort of feeding into some of the positive economic surprises. Just to give you a sense of the scope of these revisions, prior month was a 2.6% increase for durable goods orders. That was revised down to 0.8%. Mike, we've seen this. These numbers that come out, how reliable are they, given the fact that they're often revised quite considerably and revised downward?
Yeah, durable goods orders are not particularly useful because they are so volatile, and they're also driven so much normally by Boeing because airplanes cost so much money that a couple of orders still can skew everything. So you look at this and you look at the trend and you kind of wait till we get to the end of the quarter to try to put it all together.
Michael Mckee, thank you so much for being with us. Stay close. We're going to be speaking with you, I'm sure, throughout the morning, also with University of Michigan Sentiment Survey coming out at 10 a.m. Eastern, including those key inflation expectations. We can talk also about methodologies and some of the questions around that. But nonetheless, people do take a look at it. Joining us now, I'm so pleased to say, Nationwide's Kathy Bostancic and Alberto Gallo of Andromeda Capital Management. Kathy, what do you make of yesterday's data in particular? I really want to start with that and how much that has sort of forward-looking indications of goods prices starting to really, I don't know, go up, reaccelerate.
Yeah, good morning, Lisa. Happy to be with you. Yeah, I think, that's, something that's quite interesting because goods prices, as you know, have really been the positive factor here in the inflation story, and have actually the latest data sort of suggested, when you look at CPI, that is, that we had further deflationary pressures. If that starts to temper or we see some uplift, that could really, change the story here. Goods, gasoline prices, obviously headline inflation, very sensitive to that. And the reason that again matters is that we still have this ongoing stickiness in the service side of the economy, whether it's core services or also looking at rental inflation.
And Kathy, this is the reason why people are talking about whether there is some sort of restrictiveness currently in the system. Alberto, you wrote a fascinating note about this, just how restrictive Fed policy actually is and how it's sort of, I don't know, a mirage that they're using front end of the yield curve to try to seem like they're restrictive, but they're really not so much. Please explain, because to me, this is fascinating at a time where people are pushing back their expectations of a rate cut.
Good morning, Lisa. Essentially, what we're talking about is the Fed trying to perform a magic trick. They have focused the audience attention on the front-end rate, and they've raised front-end rates by 500 basis points. But on the other hand, what they're doing is to reducing the pace of tapering, and they've reduced it by more than expected. So the Fed balance sheet is still, very large, and it hasn't really fallen since the peak. At the same time, there's also a lot of fiscal and there's indirect QE. For example, the bank term funding program has allowed banks to fund cheaply to buy treasuries. So, they're hiking with one hand, they are not hiking with the other. The result is that there is a record loose financial condition. So we definitely don't see any restrictiveness in financial conditions right now, unless you're a weak household and you're funding with credit cards or auto loans, so you're depending on the front end rate. But for large firms, for whoever funds in the bond market or long-term mortgage borrowers, funding conditions are still pretty good. And that means persistent inflation. It means that there's rates volatility, and we are a lot more worried about reacceleration in the economy or persistent inflation, hurting the rates market rather than the recession that, every economist has been thinking about for the past 3 years.
Well, Alberto, we got a fresh call from Goldman Sachs this morning saying that they now expect a cut to be in September. Initially, they were talking about, most recently, they were talking about July. What do you view in terms of the timeline, given what you're saying about the policy not being so restrictive?
I think here the trade is for next year. Yes, we might have one cut this year. Our forecast is still for 0. But the reality is there's still a lot of cuts that are priced in for 2025. And I think that is wrong, especially with the outlook that we have for elections. We're going to have a lot of fiscal stimulus next year. regardless of who wins. But there are some scenarios where there's even more fiscal stimulus than the CBO is expecting for next year. So we have persistent fiscal, and the 80+ basis points cuts that we are seeing in the market for next year are not going to happen in our view. So yes, we might have a cut, but it's going to look like a policy error in our view. And even other central banks are starting to change the narrative. So we need to learn to live with higher for longer. And there's a lot of asset allocation that has been centered around the expectation of lower rates. And that's going to have to reprice.
Kathy, I know you also think cuts could be delayed in a certain scenario till 2025. But Alberto there is talking about potentially the fiscal impulse we'll also get in 2025. How much harder is that going to make the Fed even to cut next year?
Yeah, I'm not so sure we get a lot of fiscal stimulus next year. Certainly, if we do, then that would delay, or dampen Fed rate cuts. But I think, from my perspective, we are seeing some moderation in economic activity. Right now, it's just the first step, and there's a long ways to go in terms of economic activity and also inflation. But we're still hopeful that we do get some further drop in inflation, particularly we think rental inflation. But the problem is it may be brief, right? Because we've seen some signs of rental inflation picking up and home prices picking up. The problem is there's long lags, right? Typically it's about 12 months. This time it seems to be longer. But so we're hopeful that we do get further cooling in inflation. I think that's really what matters most for the Fed. And I would agree with Roberto, there's like a tale of two economies going on right now. If you can come to capital markets, you're a large corporation, and you termed out your debt, you're in pretty good situation. But if you're a small business, or if you're a middle income household or lower income, you're a variable rate borrower, you are feeling the pinch. And I think higher rates have had an impact. Look at the housing market. The existing home sales market has been essentially stalled.
And that's potentially part of the reason that small caps, for example, haven't kept up with the gains. Alberto, in this idea that policy is easy, not just because of the fiscal, but because of QT2, the Fed would say to that they are slowing the drawdown of the balance sheet, not because they want to ultimately not draw down as much, but it allows them to do it for longer and potentially ultimately get to a lower level because they can keep drawing down without the risk of any financial accident. What would you say to that?
Well, the first phase has been very easy for central banks because inflation came down thanks to an easing of supply constraints, and also we had a very strong inflow of immigration, of relatively cheap labor. Now, these one-off positives are going to fade. So the first phase of disinflation has been much easier. Now it's the hard part is what's ahead of us. So we have less flow of immigration, and we actually have still supply constraints that are persistent, and there are some feedback loops. So the idea of keeping the balance sheet very large and making it come down very slowly, in theory, looks good. But in practice, what it does is that it keeps financial conditions loose for a large chunk of the economy. So there's no real tightening for large firms, for mortgage borrowers that are long-term. And so I think that the result of higher front end, but also persistent fiscal and a persistently large balance sheet has been that financial conditions are not as restrictive as the Fed thought they would be. And the narrative is changing. I think that some Fed presidents are already taking that into account, which means that you won't be able to do a lot of cuts. But the other consequence is that eventually some central banks will have to choose between price stability and financial stability. So it is true that it's really good to not cause any issues in the financial market, and no one wants it ahead of elections. But the mandate is also price stability, and I think that there's been a lot of micromanagement of volatility from central banks. We see it in the allocation of risk assets. We see it in the love for credit and for carry that there is in the market right now. We're at record tight spreads. And investors, are essentially ignoring this front end 5% rate because the long end is inverted.
Kathy, would you just say to that Alberto's wrong because it's just a lag? That's actually what we're seeing, not that policy isn't tight enough?
Well, I have some sympathy to Alberto's comments. I mean, certainly financial conditions are easy. Part of that's because the equity market continues to rally so much, and we do have an inverted curve. But long-term rates are higher. I think in terms of, you think about mortgage borrowers, they're still looking at 7% rates. That's quite draconian, especially compared to where we were. And I think some corporations, if they have to come to market and roll over their debt, they are facing higher refinancing costs. But in general, yes. I mean, if you're an asset holder and you're a corporation that has a lot of cash and you termed out your debt, the short-term interest rates are not biting as much as the Fed had thought previously. And I think that is key. And I can see the Fed holding rates higher for longer, and possibly, if need be, would raise rates higher. So I have sympathy to that. I think it just really does depend, though, on inflation. If we start to see inflation trend lower, then the Fed will have the green light to start cutting rates, especially next year.
On this show, just a couple minutes ago, we were talking about deflation, and we were talking about deflation when it comes to gasoline prices. In particular, we had this discussion around the average price going down to $3.29 from the current $3.61 in the United States. Michael Mckee is still with us. Mike, I wanted to talk with you about how important that is from an economic perspective, from consumer spending, from what this does to the package of household budget that can go to other things. How stimulative, essentially, would it be if gasoline prices go down significantly?
Well, the change that we've seen so far isn't that significant. What you usually see in terms of gasoline prices is when they go over the previous high, that's when people start to pull back and get nervous because it's something that they really notice. Slight changes, 10, 20 cents either way, they bother them more on the upside. But it hasn't had an impact overall on spending in a while because gas prices have been sort of in this range for some time.
Well, and this is a reason why, Kathy, a lot of people were looking at this expectation that we were going to end up with a really crimped consumer where you had savings running out and you had some of these inflationary pressures, people talking about a commodity shock. None of it materialized. So where are we on that? Do we have a consumer that has run out of savings and is increasingly strapped? Or do we have a consumer that can tap leverage, that has plenty of capacity, and particularly at the higher end, still tons of money?
So I would say more in the former camp, Lisa, is that I do think, large portions of the consumer sector is tapped out. They have run down, the $2 trillion worth of pandemic-related savings. They've ramped up consumer credit card use, right? And we're seeing, if you look at the New York Federal Reserve survey, 10% of credit card holders are now seriously delinquent. And you see that also with auto loans, delinquency rising. You typically don't see that when the unemployment rate is, less than 4%. That's usually a recessionary sign. So I do think we're hitting some roadblocks for the consumer. But what's going to matter most is employment growth and wage growth, right? I think now the consumer is really dependent on current income stream to fund spending. And the savings rate's at 3.2%. There's not a lot of extra buffer there for the consumer to run things down.
Alberto, final word?
I think there's some weakness. There's a little bit of cracks opening across the weakest part of the employment market and the credit market too, but it's not enough to create the conditions for a lot of cuts. And in the meantime, outside of the US, we see China stimulating, Europe spending. So, global financial conditions are very loose. Commodity prices are going up. We're still, much more worried about the right tail. So things going too well versus the left tail, which is the typical recession risk. So, we're going to see more vol in rates, and maybe we'll retest the highs in yields throughout the year.
Nationwide, Kathy Bostancic and Alberto Gallo of Andromeda Capital Management. Both of you, thank you so much. Have a wonderful long weekend. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. JP Morgan will have to pay $100 million to settle a multi-year probe into the bank's trade monitoring. The CFTC said that JP Morgan failed to properly monitor billions of client orders between 2014 and 2021. Staff at the bank found significant gaps in its surveillance of trade data that were not monitored across at least 30 trading venues. In a statement, JP Morgan said, quote, significant remedial actions have been taken and that the surveillance gaps were resolved last year. Meanwhile, a good day for Nvidia CEO Jensen Huang yesterday. His net worth growing by almost $8 billion to $91 billion as shares of Nvidia rallied 9% after reporting better than expected quarterly results. A majority of Huang's net worth comes from his stake in Nvidia, the company he co-founded back in 1993. Huang is now the 17th richest person in the world, according to the Bloomberg Billionaires Index. And as Anne-Marie mentioned, Goldman Sachs is pushing back expectations for the Fed's first rate cut. Chief economist Jan Hatzius is now betting the Fed will cut in September rather than July. A new note to clients says recent PMIs and jobless claims will not give Fed officials the confidence needed to lower rates. The note went on to say a second cut is expected in December. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting your week ahead for the day, for the week. We get a sense of what's going on. You are watching Bloomberg Surveillance. Welcome back. This is Bloomberg Surveillance on the last day before a long weekend, counting you down to the opening bell. Here is your trading day, setting you up for the day and the week ahead. At 10 a.m., we'll get University of Michigan consumer sentiment data. The Treasury market closing early at 2 p.m. ahead of the long Memorial Day weekend. U.S. and U.K. markets are both closed on Monday. We're still trying to figure out why in the U.K., a bank holiday. Tuesday, we'll get consumer confidence data ahead of U.S. GDP and core PCE on Thursday. Personal consumption very much front in focus. Jay Pulaski of TPW this morning, very much in the Dan Ives camp, saying don't sweat the details.
Most people talk about us being late cycle going into recession. That's been the thesis for the last 18 months. People still have it, even though it's been wrong for 18 months. So our feeling is that we're early cycle. We're in the beginning of a manufacturing pickup. We're in the beginning of a CapEx boom to build out all the things we spent time talking about earlier this morning. And that, for us, leaves us constructive. So we don't sweat the detail.
Jay definitely is feeling good because he's gotten a lot of calls right this year talking about artificial intelligence in the tripolar world. Annmarie, you picked this out in particular, this idea that he thinks geopolitical risk is frankly a buying opportunity because it never comes to pass in markets. What are you sort of looking at on that sphere?
When I think people talk about geopolitics, I have to go back to what happened with Russia's invasion of Ukraine. This idea, this sentiment, Angela Merkel led part of this, that the more you integrate potentially adversaries into your economics and finance, the more likely there could be peace. Think of Europe's reliance on Russia. But in 72 hours, we saw a lot of that fall apart. So that's why sometimes I pick holes in some of Jay's thesis.
Well, and he was up for the debate. He said, have me back in 6 months and we'll discuss once more. After all of that, all of the conflicting kind of views that we heard there, we heard some people talking gloom and doom about Lee Farage in particular, rate hikes really torpedoing some of the strength that we've seen in stocks. We heard Jay Pulaski going full bull. Annmarie, what kind of stands out to you? What's your final thought?
Well, I'm looking ahead to the University of Michigan sentiment. I want to know where the consumer, the American electorate is on inflation. Even if I don't always trust the data. And this sparked my attention today from Paul Donovan over at UBS. Politicians weaponize economic statistics, particularly at election time, to paraphrase that iconic economic resource, the Princess Bride. The voters' response is often, quote, you keep using that data. I do not think it means what you think it means. Economic data does not win votes. People are not feeling good about the economy, even though, to Danny's point earlier, Biden will come out and say the data is showing that the economy is doing well.
Which is a reason why you heard Janet Yellen saying, basically, inflation is too high. I understand how people feel. We've got to do more. We're doing our best. We've made some progress, trying to toe that line between basically heralding progress, but also talking about just acknowledging what people are feeling. Danny, what's your takeaway? I mean, basically, we're hearing about AI is going to save the world and every robot under the sun is basically going to make us all richer, better, and thinner. And then you've got other people saying, just hold on a second. We haven't killed the business cycle.
Yeah, well, it's clearly not going to save the stock market if you can get a day where Nvidia rallies nearly 10% and the rest of the market, albeit by a small amount, is down. it's this philosophical debate that I think is really interesting. Is AI going to give us the productivity boost that the 90s saw? And even here, Lisa, we had two very different opinions. You have Ian Shepard saying that, no, it's not, because the rollout of that, it's not like the internet where everyone can just go online and sign up for a website. It takes time to incorporate AI, whereas Jay Ploskey basically saying the infrastructure is there and it's being built up really rapidly, and we're underestimating the impact it's going to have.
I want to say, ChatGPT, what's the argument to have me come back to the office? And maybe that could sort of help productivity.
It will say, stay at home because I want to take your job, Lisa.
Coming up on Tuesday, RBC's Lori Calvasina, Jane Foley of Rabobank, Michael Purvis of Taubacken, and Pooja Sriram of Barclays. Dan Neuberger, thank you so much for spending 3 hours with us. Have a wonderful weekend. Anne-Marie, Danny, both of you, good luck in your travels and in the lines. You can report back whether you had clear or not and what your experience of it was. Right
Clear
now,
and TSA.
You've got
Gotta have both. You have to have both.
Fully loaded.
You basically walk in, here I am. This is Bloomberg.